Hello and welcome to Session 14 of the Basic Tax course. We're going to begin Session 14 with a review of the Session 13 homework answer key. And here is the Session 13 homework assignment, beginning with question number 1. Angela has an IRA and she made the following contributions to her IRA. We show each year and the amount contributed and the deduction she was allowed to claim in that year. Well, this is actually a pretty simple assignment. You take the amount she contributed, subtract out the deduction she claimed, and the balance is going to be the amount that is basis to her. Going over to the answer key, the correct answer is B, $4,000, and it's calculated as follows. We go by year, taking the amount contributed, subtracting out the amount deducted, and leaving the amount left to add to basis. And, of course, we're left with original contributions of $7,500, amounts that were previously deducted on other year tax returns of $3,500, leaving Angela with her tax basis of $4,000. On to question number 2. Sally Summers purchased 80 shares of XYZ stock on 4/15 of 09 for $500. On 9/6 of 09, there was a 2-for-1 split, and on 9/9 of 10, there was a 4-for-1 split. Sally has not sold any shares of her XYZ stock. Assuming there were no other purchases or sales, how many shares of XYZ stock did Sally own on the last day of 2010? Well, this is actually a pretty simple exercise as well. We're simply asking you to take a look at how stock splits are going to multiply the number of shares an individual holds. Sally originally purchased 80 shares of XYZ stock, but the stock splits means she now owns a greater number of shares, and each of the shares she owns now has a lower basis. So we look at the original purchase and the number of shares that she purchased. If we say that there's a 2-for-1 split, we'll go 2 times 80 is 160. If that's followed by a 4-for-1 split, 4 times 160 is 640. And each time we multiply out the number of shares, the cost basis for share is divided. So she originally purchased 80 shares at $6.25. If those shares double in number, then the cost per share will drop by half. So $6.25 divided by 2 is $3.13. And if there's another 4-for-1 split, we'll go $3.13 divided by 4, and that gives us 78 cents per share. And you'll observe that all the way through, the total cost in all shares held is unchanged, but the cost per share has dropped and the number of shares has increased. Now, number 3 is using the same information provided in question 2. What was Sally's per share cost basis in her XYZ stock on 12/31/2010, rounded to 2 decimal points? And of course, we gave you that answer already. It's 78 cents per share. In 2007, Jan bought 50 shares of ABC stock for $1,500. In 2008, she earned and reinvested $150 of dividends, which were used to purchase 3 more shares of ABC stock. Her reinvested dividends for 2009 were $200, and 5 more shares of ABC stock were purchased. Her 2010 dividends were $300 and were used to purchase 4 more shares of ABC stock. Then on 10/5 of 10, Jan bought 20 more shares of ABC stock for $1,200. There was a 2-for-1 split on 10/11 of 10. And Jan has not sold any of the shares she purchased. So how many shares does she actually own? Well, it's our job to sort through all of this and figure that out. And the correct answer is 164 shares, but let's see how we go about calculating that number. We begin with the original number of shares she purchased in 2007, and then each time in 2008, 2009, and 2010 when she purchased new shares through dividend reinvestments, we add those numbers of shares purchased into her total. And then finally, we told you in the wording of the problem that on 10/5 of 2010, she invested $1,200 more to buy 20 shares. So we add up all of those shares. But then there was a 2-for-1 split that doubled the amount of shares she owned. And the 2-for-1 split occurred after she made this final purchase on 10/5 of 2010. So essentially, the total number of shares she has is 82. If we go 50 plus 3 plus 5 plus 4 plus 20, we end up with 82 shares. But that number of shares doubled in a 2-for-1 split, so that leaves her with 164 shares. What is her average cost per share? Well, we look at the total amount of after-tax dollars she has used to purchase shares over time, and we add those up. When we add them up, we get $3,350, and that gives us an average cost per share after the 2-for-1 split of $20.43. So going over to question 4, what is the total number of shares she owns? At the end of the year, it's 164. And what is her average cost per share at the end of the year? Question number 5, the correct answer is A, $20.43. The next homework question was a little more comprehensive. Janice owns a duplex. She lives in one half and rents the other. Janice received the duplex as a gift from her mother. Her mother bought the duplex in 1988 for $58,000, and the land was valued at $10,000. Then in 1996, Janice's mother spent $10,000 on upgrades to wiring and plumbing. The duplex was converted to rental use in 2007 when Janice's mother gave it to her. No gift tax was paid at the time of the transfer. The duplex had a fair market value of $150,000 in 2007, and over the past 3 years, Janice has made the following improvements. She installed a new roof for the entire duplex, a new fence surrounding the entire duplex. She recarpeted the entire duplex and put new windows in the entire duplex. She also did some sidewalk repairs, yard cleanup after a storm, repairs to the furnace, but only for the tenant's half, and then interior decorating only on Janice's half. Janice has claimed a total of $2,378 of allowable depreciation since 2007 on the rental portion of her property. She also received an insurance claim of $1,500 for damage caused by vandals to the rental portion of the property. She spent $2,000 repairing the damage. So, what is Janice's adjusted cost basis in the personal use portion of her duplex? Number 7, what is her adjusted basis in the rental portion of her duplex? So let's go over and see how we went about calculating the answers to that question. Well, for question number 6, the correct answer is $45,750. That's answer number B. Janice received the rental property as a gift from her mother. Her mother's adjusted basis in the property becomes the starting basis for Janice. To properly calculate Janice's adjusted basis in the rental property, we must separate currently deductible operating expenses of the rental from the capitalized expenditures. Also, since Janice lived in one half of the duplex and rents the other half, depreciation adjustments for the two halves of the property will be different. And question number 7, the correct answer is $40,372, and here's some information relevant to this calculation. The IRS rules covering casualty and theft losses on business property are different than personal losses. Under the business casualty loss rules, Janice can treat the cost of repairing damaged property to its original condition as a means of determining the loss on the fair market value of the rental. Since the repairs were $2,000, her casualty loss is calculated at $2,000. Janice must reduce her casualty loss deduction by any insurance reimbursement she received, and Janice calculates her business casualty loss as follows. The cost of repairing the property to pre-casualty condition, $2,000, minus insurance reimbursement of $1,500, that equals the deductible business casualty loss of $500. According to the instructions for Form 4684, business casualty or theft losses, Janice will calculate a $500 casualty loss on Form 1040 and claim that loss on line 14 and attach a Form 4797 if it is required. If Form 4797 is not required, Janice should write 4684 on the line next to line 14 on her Form 1040. Now, since Janice is claiming a casualty loss of $500, she must reduce her basis in the rental property by $500. Under business casualty loss rules, the cost of repairing business use property to its original pre-loss condition is deductible currently as a repair expense. Janice will claim $2,000 of the repair cost as a repair expense. So repairs, of course, do not add to the basis of property. Casualty loss claims that are deductible on the 1040 reduce basis. So let's take a look at this chart or this table which we use to summarize all of the different things going on with Janice's basis on both of the properties. So you can see that we have a description of each item that affects basis, the cost of that item, and the total adjusted basis as a result of that item. We then allocate that item between home basis and rental basis as follows. So on the purchase price of the property, the cost of that property becomes the basis to Janice. So her mother's cost becomes Janice's cost because it falls under the gift rules. And since it's a duplex, we're allocating half that cost to the home and half that cost to the rental. Next is plumbing and wiring, and that was done to the entire property, as was the new roof and the new fence, and the recarpeting and the new windows. So on each of these items, since the cost is allocated 50-50 between the home and the rental, we've taken the total cost and allocated that 50-50 all the way down. Now we get to the sidewalk repair. Well, sidewalk repairs do not add to cost basis. For the rental portion, that would be a currently deductible expense for the rental portion. And for the personal portion, it's not deductible at all. The yard cleanup is not deductible as a personal expense. The portion that can be prorated to rental can be deducted as a yard cleanup or maintenance expense on the rental. Furnace repairs also are not an improvement. They are deductible as an expense for the rental portion and not deductible on the personal portion. Interior decorating, if we're talking about professional decorating where an interior designer comes in and there's all kinds of window treatments put up and color schemes and so forth, it can certainly be argued that those are improvements that improve the value of the property, but they are all on Janice's personal use portion. So we're going to allocate those to Janice's home portion. So you'll see we put the full $2,500 of the interior decorating onto Janice's side. Next, we have depreciation. Well, you don't claim depreciation on your personal use property, only on the business use. This particular depreciation adjustment is going to decrease basis on the rental side of things. And then, of course, the net vandal loss to the rental property is a decrease to basis on the rental property. So we end up with a total home basis of $45,750 and a total rental basis of $40,372. The next question in line involved looking at closing papers, and the character involved is Jack Russell, and he purchased a fixer-upper house on 10/5 of 2008 for $100,000. He purchased the home as an investment, and on 1/1 of 2010, the house was listed for sale with a real estate agent for $210,000. Jack incurred the following expenses in the month leading up to the purchase of the house. He traveled, and he had auto. After purchasing the house, Jack incurred the following fixing-up expenses: new roof, new appliances, painting, and rewiring. Jack also incurred the following expenses relating to the house: mortgage interest in 2008, mortgage interest paid in 2009, property taxes for each of those years, and utility charges. Closing papers relating to the purchase of the fixer-upper house are included using the information provided above, and from the attached closing papers, calculate Jack's basis in his fixer-upper. Well, fixer-uppers are a pretty popular way for people to make money, and the IRS commonly refers to them as flippers. And flippers, depending on the way you go about the business of fixing up and flipping houses, the IRS could look at that as a business and consider it to be a form of self-employment income, or they could look at it as a kind of a one-time investment item for an individual who is not really in the flipper business. So at any one time, you might have an individual who gets it into their head that they're going to buy a house, a fixer-upper. They're going to buy it because they think it's a good deal. They think that they can hire some contractors to come in and work on it, spend $30,000 cleaning it up, upgrading it, and then sell it and make some money. The other way that flippers go on is you have people that make it their business to purchase flippers. They're basically contractors. They go in, they buy this fixer flipper, they spend a few weeks or months physically working on it themselves. They're in there with the paintbrushes and the hammer and nails, and they're working on it. So how do you decide whether the fixer flipper belongs on a Schedule C as business income or whether it belongs on a Schedule D as investment income? Well, the facts and circumstances of the case really dictate that, and IRS essentially says if it's a one-off thing, not more than once a year, once every other year, you can probably get away with putting it on the Schedule D. But if you've really got this active enterprise going where you've got people who are working on 2-3 flippers in a year, that's definitely a business. And in any event, what we're concerned about for Jack is his net cost in this property. And so we're going to take his original acquisition price, his shopping expenses, when he was traveling around making a decision what fixer flipper to purchase, and then, of course, all of the costs associated with maintaining that property while he's working on it, as well as any of the closing costs from the purchase that need to be added in. So let's take a look at these closing papers and see what's going on here. Well, we have a contract sales price of $100,000, and then there's this line that says settlement charges. But it's dangerous just to grab the settlement charge line and go with that, because you really need to be concerned with what made that settlement charge amount up. And we can see that there's going to be a number of different items appearing on these closing papers. Deposit, well, the amount of deposit or earnest money does not affect basis because the difference between the deposit and the amount borrowed is going to go right back up to the sales price. Moving on to page 2. And here we are on page 2. Now we've got some numbers that matter. We have a loan origination fee of 1%, and we have a point fee of another 1%. And since the amount being financed is 90%, we see that we have 2 points, 1, 2, totaling $1,800 of points paid. Those will add to the cost basis in the property. They have to be capitalized. There's also an appraisal fee and a credit report fee, and those two are going to add to basis. Moving on down, we have mortgage insurance premiums. There's nothing on that line, but immediately above it we have daily interest charges. Well, these, like the property taxes, are going into an escrow account. They're not going to be treated as additions in and of themselves. We're going to look at the total interest paid for the year and assume that this amount is included in that figure. We then have an initial deposit to the escrow account. That is not an expense. The money going into escrow is basically like in a savings or a reserve account. It is not counted as an expense until it is paid out. We also show homeowners insurance and property taxes, and those two are going into escrow and are not expenses directly. We then have the title insurance. Title insurance absolutely would add to cost, as would the document preparation and the notary public fees. And finally, these government recording fees also add to cost. And then down at the very bottom, we have a pest inspection report that was $150. So let's go over to the answer key and see what we did with all of those numbers. And you will see here that the total of all of these miscellaneous fees comes up to that $6,477.44. But again, we don't take that total amount and say, oh, that adds to basis, or oh, that's deductible. We have to look at what the components are and separate those out. And here is the correct answer. The correct answer is C, $129,994. And here is how we calculated our answer for Jack Russell. The fixer-upper house is a capital asset. It is not an income-producing property such as a rental property. And because the fixer-upper is not in service as an income-producing property, all costs associated with purchasing, holding, and improving the property are capitalized expenses. All of the costs associated with shopping for and purchasing the property are also capitalized expenses. And the total cost basis of the fixer-upper is calculated as follows. So we have the description and the cost that we have included in our answer key. And of course we included the travel, the auto, the new roof, the appliances, the painting, the rewiring, and the 2008 and 2009 interest, and the 2008 and the 2009 property taxes, as well as the utilities. The amount that we felt was allowable as settlement charges totaled $6,477. Also, of course, the purchase price of the property, but we took out adjustments for prepaid insurance, prepaid interest, and for tax deposits. And that leaves us with a total of $129,994. So looking at the closing papers, you can see we did add to basis the $64.77 and 44-cent total. There is a match between these two numbers. But as I showed you, not all of the numbers that make up the $64.77 are amounts that add to basis. The first of which is the mortgage interest. We've already included that in this line right here for 2008 interest paid, so we can't double it up again. So we've taken that $427 on the closing papers and subtracted it out. So in addition, we have the prepaid insurance of $300 and the prepaid property tax or property tax deposits of $750. Where did we get those numbers? They appear right here on the closing papers. We have $300 for homeowners insurance. We have $750 for property taxes. Those were subtotaled here at $1,050, and both those amounts do not add to cost basis. Those are deposits into an escrow account. When that escrow account paid out, the property taxes were paid, and it's the actual amount of property taxes that were paid that is added to basis, and we took those amounts right here, 2008 taxes that went out from proration, and then 2009 property taxes that would have come from the escrow account. The $1,600 payment that came out of escrow, $750 of that could be due to the contribution made at close. So that concludes the review of the homework assignment for Session 13. At this point, please push pause on the video playback, take the Session 13 quiz, When you are finished taking the Session 13 quiz, resume video playback for the Session 14 lecture. All right, let's get going with Session 14. Session 14 is about depreciation and amortization. And if you can believe it, this is one of my favorite topics. Here's why. I'm not, nor have I ever been, completely very comfortable with numbers at all. And when I first started taking my own basic tax course, I was a student in a basic tax course class back in 1993, and my instructor started talking about depreciation, my head went into a tailspin. How was I ever going to learn this? This was too complicated. I almost went into a panic. And the only way I could deal with my panic was to really sit down and decipher depreciation, figure out what made it work. And the reason I was so concerned was that my instructor started to show me these tax tables, or these depreciation schedules they were, and all these numbers and all these lives and all of these methods and conventions, and it was like more than my head could handle. So I sat down and figured out, if they have a table, where did the number on the table come from? Why did it come from there? How did they get that number? Because once I could understand how the table came to be, I figured it would be much easier to understand the math or the formula behind the table than it would be to memorize the actual table. Back then I didn't know that they weren't going to ask me to memorize the table, but I was assuming the worst. So I really went overboard, maybe, perhaps. But as a result of that, from the very beginning, depreciation stuck. I've always understood it. So it's not something that built, or that my level of comprehension built from really no comprehension at all early on to, oh, wow, I finally get it 10 years later. It was pretty quick, but that was only because of the effort I put into it. And most instructors don't take the time to really explain depreciation well, and or there's the side of the student where the student doesn't take the time to really decipher it and understand it the way I've just explained how I did. So as we approach today's topic, I want you to be aware that it is a little bit different than some of the other things we've been looking at in this course. You, of course, have the same rules that we're always learning, rules about what you can do, rules about what you can't do. But now we also have some definitions and some methodologies that go into calculating items under each of those definitions that you essentially have to learn and understand. And then all of that information attaches to a tax form called Form 4562. So we're going to be taking a look at Form 4562 today, as well as all of the rules surrounding depreciation. And I wanted to draw your attention real quickly to the publication that is associated with today's class. That is publication 946, and it is a gripping read. It is one of my favorite all-out tax publication reads. I just can't get enough of that book. So if you have not already ordered your copy, I just wanted to present it to you. And here is publication 946. I've obviously got it opened up as a PDF on my screen so that I have a little index here where I can click on different areas and go take a look at them more in depth. But really the only substitute for reading this entire publication is, well, reading the entire publication. If you find it's just too much more than you have time for at the moment, you can, of course, just settle on what I've written for you in our student manual. But the manual is meant to summarize this publication. It is not meant to be a replacement of it. Now, today during the class, I may at various times reference publication 946, and when I do, I'll pull you over to it to show you what it is that I'm talking about. Now, today's class is all about completion of IRS Form 4562. I'm going to pull it up here and show it to you just briefly. And the first thing I want you to observe about 4562 is, well, it has a lot of lines, and it has a lot of sections. It's probably one of the more intimidating forms I'm going to show you during this entire course. And because it's big and full of numbers and full of lines and full of rules, I'm going to do the best job I can of just deciphering it into its component parts and taking it section by section. In Part 1 of Form 4562, you make the election under the rules for expensing property. That election is called Section 179, Expensing. We're going to learn about that in today's class. In Part 2 of Form 4562, we look at the special depreciation allowance and other depreciation deductions, and we're going to learn about those. Then in Part 3, we claim our maker's depreciation deductions. And on line 17, we claim depreciation for assets that were placed in service in earlier years. And on line 19, we claim depreciation for all of the assets that were placed in service this year that are being depreciated under Maker's rules. We're going to learn about all of those rules. And let's just take a look at this section because it's a pretty fixed section. You can see line 19 is actually lines 19A, B, C, D, E, all the way up to I. And when we go across the top, we've got all of these columns with information that has to be entered, including the month and year placed in service, basis for depreciation, recovery period, convention, method, and finally the depreciation deduction. Well, we're going to learn what each of these columns is used for and how to calculate the number or information that is reported in that column. Then in Part 4, we have a summary, and Part 4 is actually a summary of information appearing on both pages 1 and 2. So let's go to page 2. Page 2 begins with Part 5, where we have listed property, and listed property includes automobiles, certain other vehicles, certain computers, and property used for entertainment, recreation, or amusement. When you are claiming depreciation deductions for listed property, you have to complete Section A, and there's all kinds of rules that apply. Now, right off, you'll notice that some of the information asked for in Section A is the same that we just showed you under the Makers section. That is the type of property, the date placed in service, the cost or other basis, the recovery period, the method, the convention, and finally the deduction itself. So a lot of this information is similar to what we saw in Part 3 on page 1, but listed property requires even more information be reported, and we're going to learn all about that today. Then in Section B of Part 5, we are asked to enter information about the use of vehicles. In Section C, we're asked to provide answers to questions if you are an employer who provided vehicles for use by your employees. And finally, almost as an afterthought, we have Part 6, where we enter information surrounding amortization deductions being claimed on the tax return. So that's my brief introduction to Form 4562. Let's get going with the lecture itself. Now, additional reading assignments for today's class include the instructions for Form 4562, and I will be summarizing those in today's class, giving you kind of basic instructions on what each line of the Form 4797 is used for, but there's no substitute for actually reading the real instructions. So I do recommend that as you are working your way through today's classwork and homework assignments, that you have the instructions for Form 4562 open and next to you, and that you're referring to those as you go through completion of the form. Also, there is IRS Publication 535. Chapter 8 refers to the rules surrounding amortization, and we do recommend that you read that as well. And let's begin with an introduction. If you use your property for business, you generally cannot treat the cost of the property as an expense. Instead, you must claim a portion of the cost of the property each year based on each asset's expected useful life. The expected useful life for each class of asset is shown in Appendix B of IRS Publication 946. Well, let's just go take a look at that. B of Publication 946 begins on page 102 of that publication. And as you can see, we get to Table B1, and it shows you the table of class lives and recovery periods. It provides an asset class, and each asset class has a number next to it. And then it has a description of the assets that are included in each of those classes. Then it shows you the class life in years, the GDS or Maker's Recovery Life, and the ADS or Alternative Depreciation System recovery period in years. So we're going to be referring to this periodically throughout today's class, but I wanted you to flip to this section and basically have it available to you. Now, there are two different types of property when it comes to depreciable assets. And property is classified as either being tangible or intangible. Well, tangible property is property that you can see or touch. An example of a piece of tangible property would be my cell phone. I can see it, I can touch it, I can use it. I use it for business. It is a tangible asset. And other examples of tangible assets include land and buildings, cars, television and clothes, etc. And there are two types of tangible property, real property and personal property. Real property includes land, buildings, and generally anything built on land, growing on land, or attached to the land. Think of real estate and you've got real property. Personal property includes any other form of tangible property that is not real property, and it includes such things as cars, trucks, machinery, furniture, etc. Intangible property is property that has value but cannot be seen or touched, and examples of intangible property include things like patents, copyrights, and goodwill, and the going concern value of a business, such as a workforce in place. So what is the difference between depreciation and amortization? Why does Form 4562 have a place to enter depreciation, and then at the very bottom on page 2 have a place completely different where you stick amortization? How come? Well, generally you depreciate tangible property and you amortize intangible property. So let's talk about depreciation, or what that means. Depreciation allows you to claim a deduction for the loss in value of an item because of wear and tear, age, or other cause. Under the Internal Revenue Code, there are a number of different depreciation recovery methods that allow you to claim a deduction for the loss in value of an asset. Depreciation is used on tangible property. However, prior to August 11, 1993, you could also amortize or depreciate intangible property. Amortization, by comparison, allows you to claim a deduction for the cost of an item over its projected useful life. Now, since August 11 of 1993, the law requires the cost of intangible property be amortized rather than depreciated. And amortization is always straight line. The allowed recovery period for most intangible property is spelled out in the IRS regulations. In general, most intangible property is amortized over a 15-year period. However, prior to October 23, 2004, certain costs, including business startup costs, could be amortized over 60 months. Well, we're going to take these two different ways of recovering the cost of property in turn. That being, we're going to discuss depreciation and the rules surrounding depreciation first, and after we're done with our discussion of depreciation, we'll move on to another discussion that covers amortization. So here is depreciation. Who can claim depreciation is the first question. Well, you can claim depreciation for most tangible assets that are used in your business or for rental purposes. Property used in any of the following ways is considered to be property used for business: rental property, self-employment, partnerships and S corporations, farming, and employee business expense. Remember when we learned about employee business expenses that you could claim on Form 2106 and on Schedule A? Well, one of the expenses you can claim as an employee is depreciation. So how you depreciate property depends on the type of property you are using for your business. Some of the more common types of property used for income production in a business include land, buildings, furniture and office equipment, cars and trucks, heavy machinery, farm animals held for production of income, such as milk-producing cows and breeding animals, etc., computers and peripherals, and improvements to property such as roads, bridges, landscaping, room additions, or other improvements to buildings. Note that the following assets are never depreciable: an asset that has a useful life of 1 year or less, an asset that has been placed into and taken out of service in the same year, and land. And here is our first password for the day. It is the password to open the Session 13 homework answer key, and that password is New Zealand, N-E-W-Z-E-A-L-A-N-D. And I lived in New Zealand as a child a long time ago. The next thing we're going to discuss under depreciation is depreciation systems. The law does not allow you to claim depreciable assets as an expense. This is because depreciable property has a useful life of more than 1 year and continues to have value over time. If your business property has a useful life of more than 1 year, you must generally spread the cost of the property over the assigned useful life of the property. Assigned useful life determines the rate at which the cost of the property can be recovered. The following depreciation systems have been used to recover the cost of depreciation. Now, we're in the early days, or the olden days of depreciation. We have something called pre-1981 depreciation. You could call that pre-Reagan depreciation. It's a long time ago. Prior to 1981, Businesses were allowed to depreciate property over its expected useful life. This meant that a business, rather than the IRS, would determine the useful life of business property and depreciate it accordingly. Now, as you might imagine, this meant different businesses would apply different lives to the same kind of property. The depreciation systems that were used prior to 1981 included useful lives, straight line, or an accelerated method of depreciation such as the declining balance method. Property that was placed into service before 1981 is referred to by the IRS as non-recovery property. Now, Congress decided that it wanted a change, and so in 1981 it introduced ACRES, or the Accelerated Cost Recovery System of Depreciation. Beginning in 1981, the government assigned a useful life to the different types of property used in business and created a standardized method for calculating depreciation called ACRES. ACRES rules apply to assets placed in service after 1980 but before 1987. Well, as you might imagine, ACRES was kind of a first run, and obviously the government thought it could improve things. So, in 1987, it introduced MACRES, which is the Modified Accelerated Cost Recovery System. Beginning in 1987, the government modified the assigned useful lives of business property and introduced a new system for calculating depreciation called MACRES. MACRES applies to assets placed in service after 1986, and since MACRES has now been in use for more than 20 years, most assets currently being depreciated fall under the MACRES rules. So essentially, you don't need to worry about 1981, you don't need to worry about 1986, you don't need to worry about much except MACRES, because all of that other stuff is just like gone, unless you've got someone who has an asset that's been used in business for so long, it was placed in service under those old rules. But by and large, virtually any modern day client that you're going to be dealing with, you're going to be dealing with MACRES. So let's get on with the discussion of MACRES. Now, the first part of MACRES is looking at the recovery period. The recovery period of property is the number of years over which you are allowed to recover the cost of your asset through depreciation. And there are two recovery systems: GDS, which is the general depreciation system, and ADS, which is the alternative depreciation system. Each of these depreciations has different recovery periods. Now, in some ways, they're the same. So you'll see some recovery periods under GDS are the same as they are under ADS, but as class life increases, the differences become more apparent. So we can see under GDS that 3-year property class has a recovery period of 3 years under GDS, and it also has a recovery period of 3 years under ADS. 5-year property is 5 years under GDS as it is under ADS. But by the time we get to 7-year property, we start to see a change. 7-year property under GDS is given a 7-year recovery period, but under ADS it has a 10-year recovery period. And under GDS, 10-year property has a 10-year recovery period, but under ADS it goes to 20 years. And under GDS, 15 years is 15 years, but under ADS it's 20 years. 20 years is 20 years under GDS, but it is 25 under ADS. When we get to 25-year property under GDS, look at this, it's 50 years under ADS. Then we have residential rental property, which under the general depreciation system is depreciated over 27.5 years, and under ADS, residential rental property is depreciated over a period of 40 years. Under general depreciation system, non-residential rental property, that would be, for example, a commercial building, would be 39 years, and under ADS it is still 40 years. And then if you have any kind of personal property with no asset class life assigned to it under ADS, that property is given a 12-year life. Under general depreciation, typically any asset that's not given an assigned life is usually 7 years. So when must I use ADS? Well, you must use ADS for the following property: listed property used 50% or less for business, any tax-exempt use property, tangible property used predominantly outside of the United States, and all property used predominantly in a farming business and placed in service in any year in which an election not to apply the uniform capitalization rules was made. Here's the one that I would say is the most common that we're going to be dealing with, and it's not terribly common. But if you have a client who has a rental property, and that rental property is located in a foreign country, say Mexico, got a client who purchased a vacation property in Mexico and rents it out as a vacation unit. Well, that would be a residential rental property. Here in the United States, that property would qualify for 27.5-year depreciation, but because it's in a foreign country, you would have to go 40 years on that property. And let's just suppose that that property, that vacation rental in Mexico, is furnished. Well, here in the United States, you would have 5-year depreciation that you would be able to claim on the furnishings used inside that rental property. But under ADS, that property would actually end up being depreciated over 10 years. So, is it possible to choose ADS? There are situations that I just showed you where you have to use ADS, but can you choose to? And the answer is, well, yes. Even if you qualify for GDS, you can elect to use ADS. The election must generally cover all property in the same property class that you placed in service during the year. However, residential rental and non-residential rental property can be made on a property-by-property basis. Once you make the selection, you can never revoke it. Well, let's just go back to Pubs 946 for a second and take a look at that. What IRS is saying is that you can elect to use ADS on an asset as long as you elect ADS for all assets in that same class in that same year. So here is a class. The class is 0012, Information Systems, and it includes computers and their peripheral equipment used in administering normal business transactions and the maintenance of business records, their retrieval and analysis. Systems are defined as computers and peripheral equipment. And a computer is a programmable, electronically activated device capable of accepting information, blah, 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 blah. And then peripheral equipment consists of auxiliary machines which are designed to be placed under the control of the central processing unit. Non-limiting examples include card readers, card punches, magnetic tape feeds, high-speed printers, optical character readers, tape cassettes, blah, 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 a whole bunch of them. So you could essentially say that a computer and the printer that interconnects with it could be a computer in a peripheral system. So they probably belong to the same class. And if they're in the same class, that means if you purchase a computer and a printer in the same year and you elect ADS on the computer, then you would also have to elect ADS on the printer because they belong to the same class. Let's compare that, though, to a computer which falls under information systems and data handling equipment that is not a computer, such as an old-fashioned clickety-click typewriter, if you had a reason to even buy one of those, or an adding machine, duplicating equipment, and so forth. Well, those fall under a different asset class. So they could fall under a different ADS or GDS election than items under asset class 0012. So we've learned about ADS and when you can choose ADS and when you must use ADS. Let's now look at GDS. When can I use GDS? Most assets used in a business that are not listed property used 50% or less for business qualify for GDS. So let's look at some of the maker's asset class lives and recovery periods. Obviously, Appendix B of Publication 946 shows the different asset classes and their assigned useful life. In general, an asset that has not otherwise been assigned a useful life shall be given a 7-year life under Maker's rules and 12 years under ADS rules. Virtually most every return we prepare, it is likely the case that we're going to be applying Maker's asset under the GDS system. And since we're working under GDS most of the time, that's what we're going to really focus on here. And I've summarized some of the key categories that you should be aware of. It doesn't hurt to memorize these items because in the everyday business of being a tax preparer, your computer software, when it comes to depreciation, is going to ask you to enter the class life of the asset that you're depreciating. And, well, you should know that. I mean, you should, until you know it perfectly, be looking it up, of course. But just in general, you should have a really good idea of most of the categories of assets that businesses can use and what the lives of those assets are. Let's begin with 3-year property, which includes any qualified rent-to-own property defined in Section 168I-14 of the Internal Revenue Code, and any horse other than a racehorse that is more than 12 years old. 5-year property includes automobiles and light general-purpose trucks, typewriters, calculators, copiers, and duplicating equipment, any computer or peripheral equipment, appliances, carpet, furniture, etc., used in a rental real estate activity. 7-year property includes office furniture and equipment, any property that does not have a class life and is not otherwise classified. 10-year property includes vessels, barges, tugs, and similar water transportation equipment, any tree or vine-bearing nuts or fruits, any single-purpose agricultural or horticultural structure. 15-year property includes any qualified leasehold improvement property placed in service before January 1, 2012, and any qualified restaurant property placed in service before January 1, 2012. It also includes land improvements such as fences, landscaping, shrubbery, etc. 20-year property includes farm buildings other than single-purpose agricultural or horticultural structures. So what do we mean by farm building, and what do we mean by single-purpose agricultural or horticultural structure? Well, an agricultural structure is something that is used in the raising of livestock. So think of a chicken coop. When I think of an agricultural structure, I'd be looking for a single-purpose structure that is used for livestock, such as a chicken coop. Under horticultural, we're looking at, say, a greenhouse. So a horticultural structure, that would be for me a greenhouse. Now, under a farm building, any other farm building that is not a single-purpose agricultural or horticultural structure, how about a barn? Okay, so that would be 20-year property if you have a barn. 25-year property is water utility property, which is property that is an integral part of the gathering, treatment, or commercial distribution of water that, without regard to its classification, would be 20-year property. And 27.5-year residential rental property is a building in which 80% or more of the total rent is from dwelling units. 39-year non-residential real property is any real property that is neither residential rental property nor property with a class life of less than 27.5 years. And essentially we're left with commercial buildings. 15-year makers for qualified leasehold improvements. This is a special category that I did just show you above. That is this category right here, any qualified leasehold improvement property placed in service before January 1, 2012. What's that? Well, qualified leasehold improvement property and qualified restaurant property placed in service after October 22, 2004 and before January 1, 2012 are treated as 15-year property under makers. So we just finished saying that residential rental property and commercial real property have to be depreciated over very long periods of time. And in particular, we're concerned with this 39-year non-residential real property. Let's just say you're a business owner and you take out a lease on a building and you sign a 20-year lease on a building and you spend $100,000 remodeling that building to make it suitable for the business that you're going to operate. Well, under makers' rules, even though you only have a 20-year lease, you'd have to depreciate those improvements over 39 years. A long time. Ultimately, you might probably never recover the cost of that property before you vacate the lease, right? So there is a temporary rule in place, and it actually started back in 2004, and it is always meant to be temporary, but every year they kind of tend to extend it. And the latest revision in the law extended it all the way through 2012, so it's going to be with us for a couple more years. So under the maker's life for qualified leasehold improvements, the types of improvements that a business owner would make when that business owner takes out a lease on a commercial building and renovates that commercial building to accommodate their business, that type of improvement for this short period of time is classified as a 15-year property, and that's a very important thing. We will learn more about why a little bit later in today's class. Computer software. Most business use property can be depreciated under makers. However, computer software is intangible property that is not depreciated under makers. Publication 946 on page 10 provides the following instructions for depreciating computer software. Firstly, it says that computer software is intangible property and that most intangible property is amortized and not depreciated. If you can depreciate intangible property, the straight line method of depreciation is generally used. What is the straight line method? Well, this method lets you deduct the same amount of depreciation each year over the useful life of the property. If in the first year you use the property for less than a full year, you must prorate your depreciation deduction for the number of months it is in use. And Pub 946 goes on to give this example. In April, Frank bought a patent for $5,100 that is not a Section 197 intangible. He depreciates the patent under the straight line method using a 17-year useful life and no salvage value. He divides the $5,100 basis by 17 years to get his $300 yearly depreciation deduction. He only used the patent for 9 months, April through December, during the first year, so he multiplies $300 by 9/12 to get his deduction of $225 for the first year. The next year, Frank can deduct $300 for the full year. Well, we're going to learn more about how to claim depreciation on computer software next. So how do you depreciate the cost of off-the-shelf software? Normally, intangible property is amortized in Part 6 of Form 4562, but off-the-shelf computer software is something that IRS specifically goes out of its way to say you can depreciate, but you have to do it straight line, and it's not depreciated under Maker's rules. It's depreciated under the straight line method. So you figure the amount of depreciation you can deduct following the instructions shown here. Then enter the amount you are deducting on line 16 of Form 4562. Qualified computer software is depreciated straight line over 36 months, and you would enter that on line 16 of Form 4562. Of course, looking over at Form 4562, this is Part 2, line 16, and in the manual I just have a blow-up of it here for you. Certain Section 197 intangibles computer software acquired with a business. Computer software is a Section 197 intangible and cannot be depreciated if you acquired it in connection with the acquisition of assets constituting a business or a substantial part of a business. However, computer software is not a Section 197 intangible and can be depreciated even if it is acquired in connection with the acquisition of a business if it meets all of the following tests, including it is readily available for purchase by the general public, it is subject to a non-exclusive license, and it has not been substantially modified. So an example of off-the-shelf computer software would be, Windows software or QuickBooks software. Those are off-the-shelf softwares. Smallwares for taverns and restaurants. Small items such as glassware, cutlery, and kitchen utensils and small appliances costing $500 or less may be expensed in the year they are placed in service in a restaurant, even though their useful life is expected to be slightly greater than 1 year. So what the IRS is going out of its way to say here is you don't have to enter all of the different pots and pans that a restaurant purchases onto a depreciation schedule and apply depreciation rules, that essentially, as far as a restaurant is concerned, it will run through these things faster than another business might. And therefore, in use in a restaurant or tavern, these assets do not have to be depreciated and can be claimed as an expense. Depreciation schedule. Form 4562 is the form used to report and claim depreciation and amortization deductions for business use property. The form provides space to report current year depreciation on Maker's assets. It also provides space to report a variety of other depreciation and amortization deductions. However, Form 4562 is not used to figure or track depreciation on specific assets. Instead, you should keep a separate depreciation schedule. A depreciation schedule is a document which tracks information for each asset that is or has been subject to depreciation or amortization in the current year and in earlier years. Prepare and keep a depreciation schedule to track the following information for each piece of property used in your business, including cost, date placed in service, depreciation system, depreciation method, class life, recovery period, convention, current year depreciation, prior depreciation, accumulated depreciation, current and prior Section 179 deduction, current and prior bonus depreciation, and alternative minimum tax depreciation. Keep a depreciation schedule to figure the amount and type of depreciation to enter on Form 4562. Do not submit your depreciation schedule with your tax return. Well, let me show you a depreciation schedule. So I have a copy of a depreciation worksheet or depreciation schedule on the screen in front of you now. You can find this illustration on page 18 of the IRS instructions for Form 4562. And you can see that the schedule provides space to enter a description of the property, the date placed in service, the cost or other basis of the property, the business use percentage of the property? Was a Section 179 deduction or bonus allowance depreciation amount claimed? If so, how much was it? Depreciation claimed in prior years. The basis for depreciation, the depreciation method or convention, the recovery period, the rate or table percentage at which the depreciation deduction is being claimed, and the depreciation deduction itself. Now, there's no set rule that any particular depreciation schedule has to look exactly like this. What's important is that you keep a record of how you identified a particular asset and depreciated that asset. And each asset that you claim a depreciation deduction for should be listed, and the actual computations that went into the calculation of depreciation for that asset should also be listed all the way across the form. You should keep a different depreciation schedule or a separate depreciation schedule for each business activity and not be combining activities. Now, we do have depreciation schedules loaded into the LMS, so when you are printing the forms you normally print for completion of your classwork and homework assignments, one of the forms we have available for you to print is a depreciation schedule. So you can, of course, use that, and then your schedule will be the same as the one we have in our answer key. So filing requirements for completion of Form 4562, that is, when do I need to file the form? Well, except as otherwise noted, complete and file Form 4562 if you are claiming any of the following: depreciation for property placed in service during tax year 2010, a Section 179 expense deduction which may include a carryover from a previous year, depreciation on any vehicle or other listed property regardless of when it was placed in service, a deduction for any vehicle reported on a form other than Schedule C, profit or loss from business, or Schedule CEZ, net profit from business, any depreciation on a corporate income tax return other than Form 1120-S, and amortization of costs that began during the 2010 tax year. You should file a separate Form 4562 for each business or activity for which Form 4562 is required. If you need more space, attach additional sheets. However, complete only one Part 1 in its entirety when computing your Section 179 expense deduction. Figuring and claiming maker's depreciation. Claim maker's depreciation by completing Part 3 of Form 4562, Depreciation and Amortization, for the year you first place your property in service for your business. Maker's depreciation deductions are figured and claimed in Part 3 of Form 4562, so that is actually the part we're going to start with. We're not going to start with Part 1 or Part 2, we're going to start with Part 3. And you will see that Part 3 is divided into 3 sections. Section A, where you enter maker's depreciation deductions for assets placed in service in earlier tax years. Line 18 is where you make an entry if you are electing to group any assets placed in service during the year into one or more general asset accounts. We check that box. That's not something we're going to be teaching about. Section B of the form is used to enter depreciation for assets placed in service under maker's rules during the current year. So you'll see it says during 2010 tax year. That means if you're claiming depreciation on an asset placed in service in an earlier year, that depreciation entry goes on line 17. But if it's placed in service this year, then it would be entered in Section B, and you will observe that Section B is divided by class life in years. And then we have Section C, assets placed in service during 2010 tax year using the alternative depreciation system. And then we have 12-year property and 40-year property. Form 4562 Part 3, do not enter depreciation for listed property in Part 3. On line 17, you should use a separate depreciation schedule to figure the 2010 depreciation deduction for assets placed in service in earlier years. So I've already shown you what a depreciation schedule looks like, and when you are figuring depreciation for the current year or for earlier years, you fill out a depreciation schedule. And then all depreciation that is being claimed for assets placed in service in earlier years is sum totaled on the line 17, and all depreciation being claimed for assets placed in service during the current year are individually listed out on lines 19A through I. Use the depreciation tables in Appendix B of Publication 946 to determine the class life of the property you are depreciating. Then on line 19 of Part 3 of Form 4562, enter the total cost of maker's property that was placed in service in each class for the current year. So we've learned about what a depreciation system is. Now we're going to learn about what a depreciation convention is. In applying either the acres or makers depreciation methods, you must first determine which depreciation convention applies. The depreciation convention determines what date your asset will be treated as having been placed into service. There are 3 depreciation conventions: mid-month, half-year, and mid-quarter. Under the mid-month convention, any asset placed into or taken out of service during any part of the month is treated as placed in service or disposed of in the middle of that month. And here's an illustration. You purchased a residential rental property on April 3, 2010. Under the mid-month convention, the property shall be treated as placed in service on April 15th and will be allowed 8.5 months of depreciation for 2010. Half-year convention. This applies to property other than property that is used for rent. Any asset placed into or taken out of service during any part of the year is treated as having been placed into or taken out of service in the middle of the year. And here's an illustration. You purchased a photocopier for $5,000 on November 11, 2010. Assume that the total value of all assets placed in service during the last quarter of the year was less than 40% of the total of all assets placed into service for the entire year. Under the half-year convention, that copier will be treated as if it was placed into service on July 1, and it will be allowed a full 6 months of depreciation, even though it was in service for less than 2 months. Mid-quarter convention. This convention applies when more than 40% of assets were placed into service in the last 3 months of the year. You must apply the mid-quarter convention instead of the half-year convention if more than 40% of the basis of the assets placed in service during the year were placed in service in the last 3 months of the year. Here's an illustration. You purchased the following assets during 2010: a photocopier costing $5,000, a computer costing $2,500, furniture costing $2,500. And look at the dates. The photocopier was placed in service in February, the computer was placed in service in November, and the furniture was placed in service in December. So the total cost of assets placed in service in the last 3 months of the year is $5,000. The total cost of all assets purchased during the year is $10,000. And since $5,000 is more than 40%, then we have to apply the mid-quarter convention. And under the mid-quarter convention, each asset is treated as if it was placed in service in the middle of the quarter as follows. For the photocopier, we are going to figure that it was placed in service in the middle of the first quarter. That would be the same as February 15. And we count February 15 forward. That gives us 10.5 months. The computer and the furniture will both be treated as if they were placed in service in the middle of the final quarter, which is the equivalent of November 15. So in other words, we get 1.5 months of depreciation each on the computer and the furniture. So the depreciation convention refers to the time of year the asset is treated as having been placed in service. It's either treated as being placed in service in the middle of the month, the middle of the year, or the middle of the quarter. Now we go on to depreciation methods. Both acres and makers allow a business to claim depreciation on many items under either of the following methods: straight line or accelerated. Under the straight line method, the cost of property is recovered equally over time. This means the deduction claimed is the same amount every year. Under the accelerated method, the cost of property is recovered unevenly over time. More depreciation is claimed in the earlier years and less depreciation is claimed in later years. Applying makers' methods of depreciation. Depending on the class, type of asset you are recovering, makers applies the following depreciation methods: straight line, 200% declining balance, or 150% declining balance. Let's look at straight line first. Straight line depreciation is optional for some classes of property and is required for other classes of property. The following property must be depreciated straight line: residential real property at 27.5 years, and commercial real property, including office in the home, is 39 years. Makers 3, 5, 7, 10, and 15-year assets can also be depreciated straight line. To depreciate 3, 5, 7, 10, or 15-year property straight line, you must make an irrevocable election to depreciate all assets of the same class which were placed in service during the same year under the straight line method. And here is a straight line illustration. You purchased a new computer during 2010 for $2,000. You can depreciate the computer using the straight line method over 5 years, or you can use the declining balance method over 5 years. Under the straight line method, you depreciate the computer in equal amounts over a 5-year period. Straight line depreciation is a good choice if you would like to see the cost of an asset spread equally over time. And here we go. The purchase price is $2,000. And under the straight line method, we would depreciate that $2,000 computer over a period of 5 years at a rate of 20% per year. But remember that convention? In the first year, under the half-year convention, you are allowed only a half year of depreciation. So if normal year we would get $400, in the first year we're only going to get $200. So here's how straight line depreciation would work. In the first year we get $200 of depreciation, and in the last year we get $200 of depreciation, and in every year in between we get the same amount, $400. How does the math work? Well, the original cost of the asset is $2,000, and we can multiply that by 10%. We would normally get 20% a year, but in the first year we have to multiply that by 50%. So we end up with 10% in the first year and 20% in all other years. And if you go cumulatively, that means in the first year your depreciation deduction is $200, in the second year your deduction is $400, but your accumulated depreciation would be $600. In the third year, your depreciation deduction is $400, and your accumulated depreciation would increase to $1,000. In the fourth year, your depreciation deduction is $400, your accumulated depreciation is $1,400. In the fifth year, you get $400 more, bringing your accumulated total to $1,800. And in the final year, you get that final $200, and the total accumulated depreciation is the same as the cost of the asset, $2,000. And here is a table I created just to kind of give you a visual reference of how straight line works. And you can see in year 6 and in year 1, the deduction is the same, but in years 2 through 5, the deduction is equal over time. Straight line election applies to all assets of the same class placed in service for the year. You decide to depreciate your new computer purchased in 2010 over a 5-year period straight line. In making this election, you must also depreciate all other assets of the same class that were placed in service during 2010 using the same straight line method. You cannot use straight line for your new computer and then use accelerated depreciation for your new printer purchased during the same year because they belong to the same class. You could, however, choose straight line for your printer and computer, but then choose accelerated depreciation for your office furniture because office furniture belongs to a different class than office equipment. Makers 200% and 150% declining balance methods. 2 different declining balance methods can be applied under makers. They include the 200% declining balance and the 150% declining balance methods. How does 200% or where does 200% apply? Well, that method, 200% declining balance, applies to 3-year property that is not used in farming, as well as 5- and 7-year property not used in farming, and 10-year property except fruit-bearing trees and vines. The 150% declining balance method applies to 15-year property, 20-year property, 3, 5, 7, and 10-year non-farm property. And it applies to all farm property except real property. So let's take a look at the 200% declining balance. 200% declining balance is a method of accelerated depreciation. Under this method, you are allowed to recover more of your cost early on. Specifically, you are allowed to claim 200% of what would normally be allowed under the straight line method in the first year. Each year after the first year, you are allowed to claim the remaining unclaimed basis at the same rate using the maker's depreciation tables. The tables are designed to work according to a set formula over the useful life of the asset. However, depending on the life of the asset, the formula changes to straight line after the 4th year. And here's an illustration. You purchase a new computer during 2010 for $2,000. You can depreciate the computer using the straight line method over 5 years, or you can use the declining balance method over 5 years. The 200% declining balance method allows you twice the first year depreciation allowed under the straight line method. The intention of declining balance is to allow greater depreciation early on and less depreciation later on. Declining balance is beneficial if you need the larger deduction for depreciation in the earlier years of the asset's life. And here's how it works. We take the purchase price of $2,000 and we depreciate that using the declining balance method. Remember that on a 5-year asset, you're essentially allowed 20% a year. So under double declining balance, you would be allowed 40% in your first year. So you would take $2,000 times 40% and you would get $800 for the first year. But wait, don't forget about the half-year convention. Under the half-year convention, you only get half the first year's depreciation. So that takes that $800 down to $400. For each of the first 4 years, you claim 40% depreciation on the remaining balance of the computer's cost basis. Then the formula changes to straight line for the final 2 years of depreciation. Why is that the case? I didn't write the formulas. I just figured out what they are, and I'm showing them to you. So 200% declining balance, let's look at our chart. In the first year under double declining balance, our depreciation deduction is $400 instead of the $200 we saw on the earlier illustration. But then what we have to do is we have to take $400 and subtract that from the cost of the asset. So $2,000 minus $400 is $1,600. We then multiply that by 40% and we get the second year depreciation deduction, $640. So in the first year we get $400 and in the second year we get $640. We then take $400 plus $640 and subtract that from $2,000. $2,000 minus $1,040 times 40% equals $384, and that is the deduction we get in the third year. On to year number 4. We take $400 plus $640 plus $384, add those numbers together, and subtract them from $2,000. $2,000 minus $1,424 times 40% gives us the fourth year of depreciation, $230. And this is kind of where the formula sort of just goes away on us. And IRS says that year 5 is the same as year 4. And then in the 6th year, you get half of what you claimed in the 5th year. And when you're all done, due to rounding, our total depreciation deduction came out at $1,999. We're pretty much at the $2,000 amount, and the difference is just due to rounding. And here is another depreciation graph. Remember in our first graph, year 1 and year 6 were the same, and the middle years were all the same as each other? Well, on the accelerated chart, we see that in year 1 we get a bump up, and in year 2 we have the most depreciation of all. And then after that it's a steep drop down till year 6 where we get just this residual amount. Now, I've just shown you the logic or the formula that goes into calculating depreciation under Maker's double declining balance. But IRS has made it simpler for those people who don't want to calculate it manually by telling you to go use the Maker's tables. And this is how the tables work. So in my illustration, I was showing you the logic of how double declining balance methods work, but to save you time, the IRS has given you tables. And those tables are found in publication 946. I'm just going to take you there now. And on page 74, we have Appendix A, which provides the class lives and the conventions that apply to the various classes of assets. And then beginning on the next page, we actually start to see tables appear. This particular table refers to 3, 5, 7, 10, 15, and 20-year property that is being depreciated under the half-year convention. And it shows you the amount of depreciation to claim each year. And here is that 5-year property. In the first year, you get 20%. What is 20% of $2,000? Well, it's $400. And in the second year, the depreciation amount is 32%. What is 32% of $2,000? Well, it's $640. Year number 3, 19.2%. What is that as a percentage of $2,000? Well, it's $384. And you can see that the manual math that I did to calculate depreciation under declining balance method, you can skip all of that manual math and go straight to the table. But you don't learn as much when you do it that way. So I do encourage you to do it the long way just so you're understanding what's going on. So I've taken a summary of the tables that appear in 946 and inserted them into your manual just so you have them handier. But of course, the ones that I insert in the manual are incomplete. I'm not going for as many years as the tables allow for in publication 946. I'm just trying to give you a summary. And here we have the table for the 200% declining balance property. And it shows the half-year convention amount for 5-year property is 20%. But if you're applying the mid-quarter convention, things are different. Under the mid-quarter convention, you would use a ratio of 35% if it's placed in service in the first quarter, 25% if it's placed in service in the second quarter, 15% if it's placed in service in the third quarter, and only 5% if it was placed in service in the fifth quarter. So remember that earlier illustration where we had $10,000 of assets that were placed in service during the year, and $5,000 worth of those assets fall under the first quarter, and $5,000 fall under the fourth quarter? Well, let's kind of do some math here and see what would happen. So remember, we had one asset costing $5,000 that was placed in service in the first quarter, and we had two other assets at a cost of $2,500 each placed in service in the final quarter. And under the mid-quarter convention rules, we're going to be allowed to claim depreciation according to a formula that treats the asset placed in service in the first quarter as placed in service in the middle of the quarter. So if we were just to look at a calendar year visually in our mind, we know that there's 12 months. And if we're looking at the middle of the first quarter of those 12 months, well, we're 1.5 months into the year, which means we're allowed a full 10.5 months of depreciation. So just going through with the formula for that asset placed in service in the first quarter of the year, we're going to take the $5,000 cost, divide that by the number of years that asset is depreciated for, which is 5 years. We're further then going to divide that by the number of months in a year, which is 12. And then we're going to multiply that by the number of months that depreciation is allowed for that asset, and that would be 10.5. Then we apply double declining balance, which would give us multiplied out by 2. So we go by 2 and we get the answer. And the answer is $1,750. Well, what happens when we take $5,000 and multiply it by 35%? Well, we get $1,750. Now let's look at the two assets that were placed in service in the final quarter, because those assets will only get 1.5 months of depreciation. So under that formula, we're going to take those two assets costing $5,000 total, divide that by 5 years, divide that by 12 months, multiply that by 1.5 months, and then multiply that answer by 2 for double declining balance in that first year. And what do we get? We get $250. Well, what is 5% of $5,000? Well, it's $250. So that is how 200% declining balance works, and 200% declining balance applies whether you use the half-year convention or the mid-quarter convention. These tables make the percentages easy to look up so that you don't have to do the math. But I do encourage you to do the math for both of those illustrations that I just showed you so that you can see the logic of how they're working. It really is very elementary. Now here is the 200% declining balance table for 7-year property. And under 7-year property, of course, we're taking the original acquisition cost of that property and dividing that over a 7-year period. So the tables go over actually 8 years, and I'm only showing you the first 6. So it doesn't show you the 7th year or the 8th year, and the 8th year being the year that is finally fully depreciated. But of course, the percentage tables are smaller numbers because the life of the asset is longer. Then we have a table for 150% declining balance, and we use this table for 15-year property. And again, the table only goes through year 6, but you would need to go all the way for essentially 16 years to fully depreciate 15-year property. And you can see that in the first year we have 5%, and then in the second year 9.5%, third year 8.55, and so forth, and it keeps dropping off. Now, residential rental property is depreciated straight line over 27.5 years, so it is only in the first year that there's going to be any variation at all in the amount of depreciation claimed, and that will just depend on the month you place that asset in service. But after the first year, depreciation is the same throughout until you get to the year where you sell that property, and then in the year of sale, you also apply the mid-month convention. Let's talk about bonus depreciation now. Bonus depreciation allows a business to claim additional depreciation deductions for qualified property placed in service in certain years. Bonus depreciation was first introduced to stimulate investments in new equipment by businesses during the economic recession that followed the September 11, 2001 terrorist attacks. Bonus depreciation initially allowed businesses to claim 30% of the cost of assets placed in service during the year. 30% bonus was quickly followed by 50% bonus. Bonus depreciation expired for most property placed in service after 2004. But 50% bonus was reinstated for years beginning after 2007 and remains in effect through 2012. Assets placed in service after September 8, 2010 and before 2012 are actually eligible for 100% bonus depreciation. To be eligible to claim bonus depreciation, you must have placed qualified property in service during the year. Qualified property includes maker's assets with an assigned recovery period of 20 years or less, computer software that is not a Section 197 intangible, and qualified leasehold improvements to non-residential real property. Further restrictions do apply, and you should see IRS Supplement to Publication 946 for more information. One of the things I should let you know about is that 946 for 2010 was published before some of these final regulations were passed. So Publication 946 can be in disagreement with the content of my lecture simply because the IRS published that document before Congress finished passing changes, and then the tax law changed at the end of 2010 after that document was published. Special 50% depreciation allowance for property placed in service after 2007 and 100% after September 8, 2010. The 50% depreciation allowance implemented after 9/11 expired at the end of 2004, but was resurrected for 2008 and 2009. For most new property purchased and placed in service after December 31, 2007, a 50-year additional first-year allowance is available. The Small Business Jobs Act of 2010 extended the special allowance deduction through December 31, 2010. The Reed-McConnell Tax Relief, Unemployment Insurance Reauthorization and Job Creation Act of 2010, which was passed on December 17, 2010, after 946 was published, extends and temporarily increases this bonus depreciation provision for investments in new business equipment as follows. For investments placed in service after September 8, 2010 through December 31, 2011, the bill provides 100% bonus depreciation. And for investments placed in service after December 31, 2011 through December 31, 2012, the bill provides for 50% bonus depreciation. The provision also allows taxpayers to elect to accelerate some alternative minimum tax credits in lieu of bonus depreciation for taxable years 2011 and 2012. To be eligible, the property must be maker's property with a recovery period of 20 years or less, off-the-shelf computer software, qualified leasehold property, or water utility property. This special allowance does not apply if the alternative depreciation system, or ADS, is required to be used. However, if you elect into ADS, you can still claim the 50% allowance. You can elect out of the special depreciation allowance if you don't want to take it with respect to any class of property. This means the 50 or 100% allowance is automatic for 2010. If you elect out of the 100% depreciation allowance for property acquired after September 8, 2010 and placed in service before January 1, 2012, the property does not qualify for the 50% special depreciation allowance. Figure the 50% or 100% allowance after you figure the Section 179 deduction, but before you figure your regular depreciation. And here's an example. On September 3, 2010, you bought a computer network for your business that cost $50,000. You did not elect to claim a Section 179 deduction. Calculate your special 50% depreciation allowance as follows. Multiply the cost of the network by 50%. So $50,000 times 50% is $25,000. Your special depreciation allowance is $25,000. Your remaining $25,000 cost of the network is depreciated using 5-year makers. Example number 2. Assume the same facts as in 1, except that you elect to claim $20,000 as a Section 179 deduction. You then figure your special 50% depreciation as follows. Reduce your depreciable basis in the network from 50 down to 30, and then multiply the adjusted basis by 50%. 30 times 50% equals $15,000, and your special 50% deduction will be $15,000. The remaining $15,000 cost of the network would be depreciated using 5-year makers. electing out of the 50 or 100% allowance. Now, you might imagine that not everyone wants to claim bonus depreciation in the year they acquire an asset, especially a business just getting going or a business that's already running a loss. So if you're running at a loss and you claim this huge depreciation deduction, it just makes your loss bigger. And maybe you don't benefit from that. There's probably a lot more benefit in spreading your depreciation out over time and claiming it in a future year where you're actually producing a profit. So it would depend on the needs of the business at the time, and it's our job as a tax preparer to really analyze our client's tax situation and make recommendations to them. Now, one of the things you should be aware of is that the law says that the bonus depreciation deduction is automatic. You have to elect out of it. And that means that computer software defaults to it and will automatically allow these big deductions. So if it is your opinion as a tax preparer that your client is better off without a big deduction, then you're going to have to make some manual entries in the software to override and elect out of the bonus depreciation. You can elect not to deduct any special depreciation allowance for all property in a single asset class placed in service during the tax year. If you elect out of the special depreciation allowance for one asset in a class, you must do so for all assets in that same class. However, properties in different classes can still be used for the allowance. To make an election, attach a statement to your timely filed return, including extensions, indicating the class of property for which you are making the election and that for such class you are not claiming any special depreciation allowance. The election must be made separately by each person owning property, for example, by the partnership, by the S corporation, or by the common parent of a consolidated group. If you timely file your return without making an election, you can still make the election by filing an amended return within 6 months of the due date of the return, excluding extensions. Right, filed pursuant to Section 301.9100-2 on the amended return. Once you make the election, you cannot have the election revoked without IRS consent. Now, I should let you know that you have to attach this statement to a timely filed return, including a return on extension. What that means is if you're working with a client who's filing back your returns, old returns that are late, you can't make the election. Bonus is mandatory. Now, how do you claim bonus? Figure the amount of bonus depreciation you are claiming by completing a depreciation schedule for qualified property placed in service during the year. Then enter the amount of bonus depreciation you are claiming for the year on line 14 of Form 4562. And here is an illustration of how we would figure bonus depreciation. Tiffany Banner purchased and placed the following property in service in her business during the year. Office furniture with a cost of $10,000 and computer-based telephone system costing $20,000. The total cost of assets placed in service for the year is $30,000. We have the date placed in service here. You can see that all of the assets were placed in service before the final quarter of the year, so we're dealing with half-year convention, not the mid-quarter. We have the class life of each asset showing here and the amount of bonus depreciation deduction she is going to claim. $5,000 bonus on the office furniture, $10,000 bonus on the telephone system. Total bonus depreciation being claimed is $15,000. We then take the remaining cost basis of the assets, which is $5,000 for the office furniture and $10,000 for the computer system, and we're going to apply the half-year convention. That gives us $714 of depreciation on the office furniture and $2,000 of depreciation on the phone system. Total current year depreciation will be $2,714. So how does this look on the finished 4562? Well, on line 14, we enter $15,000 of bonus depreciation. Then on line 19B, we enter the telephone system remaining basis, which is $10,000. We apply a recovery period of 5 years and the half-year convention. We then apply a method of 200% declining balance, and that gives us our $2,000 depreciation deduction. The 7-year property is the office furniture, and that gives us a $714 deduction. Let's move on now to another topic of depreciation, and that is the Section 179 expense election. Generally, you must claim the cost of an asset placed in service through depreciation. However, if you acquire and place an asset in service during the year in your active trade or business, an election to expense rather than depreciate can be made. So what property can be expensed? As a general rule, you can expense tangible personal property only. However, certain other property can also be expensed. The following depreciable property also qualifies for the Section 179 deduction. That includes tangible personal property, other tangible property except buildings and their components used for production, manufacturing, furnishing, transportation, communications, or utilities, a single-purpose agricultural or horticultural structure, petroleum storage facilities, off-the-shelf computer software, and qualified real property. Remember earlier I mentioned that qualified real estate improvements were eligible for special treatment in that they were being temporarily classified as 15-year property rather than 39-year property. Well, the fact that leasehold improvements are 15-year property means they're eligible for bonus depreciation and they're eligible for the Section 179 deduction. So compare that $100,000 of improvements that a tenant might put into their place of business, and compare 100,000 divided by 39 and the amount of depreciation you get each year over 39 years to being able to expense the entire thing all in 1 year. Boom, gone. Huge difference. So this temporary provision is big for businesses that can take advantage of it. So what is qualified real property? Well, you can elect to treat certain qualified real property you placed in service as Section 179 property for tax years beginning in 2010. If this election is made, the term Section 179 property will include any qualified real property, that is, qualified leasehold improvement property, qualified restaurant property, or qualified retail improvement property. Now, when can I claim a Section 179 expense? To claim a Section 179 expense, all of the following must be true. The property must be used more than 50% in a trade or business. The property must be acquired for use in your trade or business. The property cannot be acquired from a related person or group. You must elect to claim a Section 179 expense in the first year the property is placed in service. Property acquired for business use. To qualify for the Section 179 deduction, your property must have been acquired for use in your trade or business. Property you acquire only for production of income such as investment property, rental property, if renting property is not your trade or business, and property that produces royalties does not qualify. Partial business use. When you use property for both business and non-business purposes, you can elect the Section 179 deduction only if you use the property more than 50% for business in the year that you place it in service. If you use the property more than 50% for business, multiply the cost of the property by the percentage of business use. Use the resulting business cost to figure your Section 179 deduction. And here's an example. May Oak bought and placed in service an item of Section 179 property costing $11,000. She used the property 80% for her business and 20% for personal purposes. The business part of the cost of the property is $8,800. 80% times $11,000. Therefore, $8,800 is the maximum amount of Section 179 deduction that May can claim for this item of property. The next rule for Section 179 is that the property must be acquired by purchase. To qualify for the Section 179 deduction, your property must have been acquired by purchase. For example, property acquired by gift or inheritance does not qualify. Property is not considered acquired by purchase in the following situations. Number 1, it is acquired by one member of a controlled group from another member of the same group. 2, its basis is determined either in whole or in part by its adjusted basis in the hands of the person from whom it was acquired, or under stepped-up basis rules for property acquired from a decedent, that is, by gift or inheritance, or it is acquired from a related person, that is, you purchased it from your mother or your father or your sister or your brother. If you did, you cannot claim a Section 179 deduction. Now we're going to talk about the type of property that cannot be expensed. Even if other requirements for expensing are met, you cannot elect the Section 179 deduction for the following property. Certain property that you lease to others if you are a non-corporate lessor. Certain property used predominantly to furnish lodging or in connection with the furnishing of lodging. So if you own a rental property and you purchase furniture for that property, you cannot expense it under Section 179. Air conditioning or heating units. Property used predominantly outside of the United States except property described in Section 168G4 of the Internal Revenue Code. Property used by certain tax-exempt organizations except property used in connection with the production of income subject to tax on unrelated trade or business income. Property used by governmental units or foreign persons or entities, except property used under a lease with a term of less than 6 months. And land improvements, including swimming pools, paved parking areas, wharves, docks, bridges, and fences. Lease property cannot be expensed. Generally, you cannot claim a Section 179 deduction based on the cost of property you lease to someone else. This rule does not apply to corporations. However, you can claim a Section 179 deduction for the cost of the following property: property you manufacture or produce and then lease to others, property you purchase and lease to others if both of the following tests are met. A, the term of the lease, including options to renew, is less than 50% of the property's class life, and B, for the first 12 months after the property is transferred to the lessee, the total business deductions you are allowed on the property, other than rents and reimbursements, are more than 15% of the rental income from the property. Also, caution, property used for lodging cannot be expensed. Generally, you cannot claim a Section 179 deduction for property used predominantly to furnish lodging or in connection with the furnishing of lodging. However, this does not apply to the following types of property: non-lodging commercial facilities that are available to those not using the lodging facilities on the same basis as they are available to those using the lodging facilities. Property used by a hotel or motel in connection with the trade or business of furnishing lodging, where the predominant portion of the accommodation is used by transients. Any certified historic structure, to the extent its basis is due to qualified rehabilitation expenditures, and any energy property. So here is a summary of property which can and cannot be expensed. Examples of what can be expensed include grocery store counters, refrigerators, transportation equipment, office equipment, printing presses, signs, livestock, single-purpose agricultural structures, single-purpose horticultural structures, petroleum storage facilities, except buildings, and certain leasehold restaurant improvements. What cannot be expensed? Well, swimming pools, paved parking lots, bridges, fences, docks, buildings, heating and air conditioning units, permanent structures, property used for lodging, property you lease from others, most property that you lease to others, and travel trailers and motorhomes. How do I make a Section 179 deduction? You make the election by completing Part 1 of Form 4562, Depreciation and Amortization, claiming the Section 179 deduction on listed property. If you placed listed property in service during the year, you make the election to expense this property in Part 5, Section A of Form 4562. And the election is made right here, Part 5, Page 2, Section A of Form 4562. Let's move on now to the Section 179 deduction limits. The maximum total Section 179 deduction you can claim in 2010 is $500,000. $535,000 for qualified enterprise zone property. That is, if you have property placed in service in a qualified enterprise zone. For 2010, qualified real property that you elect to treat as Section 179 real property is limited to $250,000 of the maximum $500,000 deduction. So what this rule is pertaining to is, let's just suppose you have a business that took over a retail location and you went and put in a ton of money into leasehold improvements, and you want to be able to claim a Section 179 deduction on those. Well, the IRS says you will be able to do so, but not more than half of the Section 179 deduction limit can be applied to that item or to those improvements. So the most Section 179 deduction you can claim for leasehold improvements is $250,000, but the limit on all Section 179 deduction is $500,000. So if you have non-leasehold improvement items, you can go up to $500,000. Note, special depreciation rules are in effect for certain property placed in service inside New York's Liberty Zone or inside areas affected by Hurricanes Katrina, Rita, Wilma, or the Midwestern Disaster Zone. These special depreciation rules are not a part of this session. For more information on rules affecting property inside these areas, refer to Publication 4492. So if you happen to reside as a tax practitioner in one of these casualty areas, or one of these disaster areas, there are some special limits on depreciation that you should be aware of, and you should take the time to look them up in Publication 4492. No Section 179 deduction allowed. You may not be allowed to claim the full $500,000 deduction if the total cost of all qualifying Section 179 property placed in service during the year is greater than $2 million, or your cost of qualified property placed in service during the year is greater than your taxable income from active conduct of a trade or business, prior to figuring the Section 179 deduction, self-employment tax deduction, or NOL deduction. Please note that income from active conduct of a trade or business includes income from wages, so that if you are self-employed and you are running at a loss on your Schedule C from your business on Schedule C may not allow you to claim a Section 179 deduction by itself. But if you have other income showing on your tax return from a business, including wage income, then your Section 179 deduction could be allowed to offset other types of wage business type income. Also, please note that married persons must share this limit. For purposes of calculating the maximum deduction and the maximum dollar limits, a married couple is treated as one taxpayer. It does not matter if they file jointly or separately. They must share the same allowable limits. Recapture of Section 179 deduction. If you sell property for which you claimed a Section 179 deduction, you may have to recapture part of your allowable deduction. You will have to recapture your deduction if you dispose of your property before its maker's useful life has elapsed, or your business use of the property drops to 50% or less. For example, you purchased a computer for $2,000 in 2009 and use it 100% in your business. You made a Section 179 deduction on your 2009 return for the full $2,000 cost of the computer. Then in 2011, you purchase a new computer and you give the old computer to your children to play games on. Since you claimed a Section 179 deduction for the old computer, you must recapture the excess depreciation on your 2010 tax return. Now, we will teach you about this particular item in our very next session, Session 15, where we cover recaptures and sales of business assets. Listed property. Certain depreciable property is more closely scrutinized because it can be easily used for personal as well as business purposes. Such property is called listed property. Listed property includes any passenger automobile that weighs 6,000 pounds or less, with some exceptions for specialized trucks and utility service vehicles. Refer to IRS Publication 946 for more information. Any other property used for transportation, such as airplanes, boats, motorhomes, unless it is an accepted vehicle. Property generally used for entertainment, recreation, or amusement, including photographic, phonographic, communication, and video recording equipment. And computers and related peripheral equipment, unless they are owned by a business owner and used only at a regular business establishment. Certain property eliminated from the definition of listed property. Well, for all the years I've been in taxes, there was a very specific item that was considered to be listed property and therefore was closely scrutinized by the IRS and required strenuous record keeping and strict adherence to rules, and that was cell phones. So for all 18 years I've ever been in tax preparation, cell phones were treated as listed property, and bang, after 2009, cell phones are off the list. They are no longer listed as listed property. For tax years beginning after 2009, cellular telephones and similar telecommunications equipment have been removed from the definition of listed property. Predominant use. You may claim a Section 179 deduction only for property that is predominantly used for business. Predominant means more than 50%. You cannot claim a Section 179 deduction for listed property that is 50% or less business use. Further, if you've previously claimed a Section 179 deduction on listed property and in a subsequent year business use falls to 50% or less use, then you may have to recover part of the deduction claimed under Section 179. How to report listed property. Claim depreciation deductions for listed property in Part 5, Section A of Form 4562. Most assets are reported on Form 4562 for the year they are placed in service only. However, listed property must be reported on Form 4562 every year it remains in business use. So in Part 3 of Form 4562, we show these items of information. That is, the type of property being used, the date placed in service, the cost or other basis, the method. Those items are shown in Part 3 only for the year an asset is placed in service. But if the asset is listed property, then listed property has to have this information shown every single year it is in use for business purposes. Special rules for passenger automobiles. The amount of depreciation and Section 179 deduction you can claim on passenger automobiles is limited. A passenger automobile is any four-wheeled vehicle made primarily for use on public streets, roads, and highways and rated at 6,000 pounds or less. The following are not considered to be passenger automobiles: ambulance or hearse used directly in a trade or business, or a vehicle for hire used to transport people. Maximum depreciation deduction for passenger automobiles. For 2010, the maximum total depreciation and Section 179 deductions you can claim for a passenger automobile placed in service is $11,060. However, if you elect not to claim any special depreciation allowance or the vehicle is not qualified property, then the maximum deduction is only $3,060. If your vehicle is less than 100% business use, your maximum depreciation allowance must be multiplied by the percentage business use of your vehicle. The following table from Publication 946 on pages 65 through 66 outlines the maximum deductions for each year. Here you will see if 2010 is the first year that you placed your vehicle in service, then the maximum deduction is $11,060. But you can see that there's a little 1 next to there, and if you go down, it says if you elected not to claim any special depreciation allowance for the vehicle or the vehicle is not qualified property, then the maximum deduction is $3,060 only. Now, in the second year, your depreciation deduction is limited to $4,900. In the third year, $2,950, and in the fourth and all later years, $1,775. And you can see that these numbers are pretty flat. For whatever reason, they do seem to vary by maybe $100 one year to the next, with no particular reason for going up or down by $100. In 2009, the limit was $10,960, and it was the same in 2008. Then in 2007, we see this $3,060 limit. Well, that's the same as it would be in 2010 if you don't claim bonus. 2006, it was $2,960. 2005, it was $2,960. But look at this. In 2004, it was back up at $10,610 again, and that was because bonus depreciation was in place in that year. But you go back in time to 2000, the limit was $3,060, and that's $100 higher than it was in 2006. So I really don't know what the method or madness behind any of this is. These are just the facts that you should be observant to. And of course, in 2009, second year depreciation. So what that would mean is, say in 2009 you were depreciating a car and 2009 was the second year, then the depreciation in 2009 for that vehicle was $4,800. And if in 2010 you have a car that is in service in its second year, that deduction is $4,900. But why is it 49, then 48, 48, 49, 48, 47? Again, I don't know. So in general, the limit for the second year is between $4,700 and $4,900, and you just need to look it up year to year to see where you're at. The third year, again, we're within $100 every year. Look at this, 1997, the limit was $3,050. And here we are in 2010, and the limit's $2,950. Again, no rhyme or reason. Obviously, there's no adjustment for inflation whatsoever over time in these calculations. So what those limits on passenger automobiles mean is that if you calculate depreciation deduction on an automobile and that deduction is more than the limit allowed, then your deduction is limited to the limit, and that limit is really low. So it's pretty difficult to place a car in service and not have depreciation limits on passenger automobiles affecting the deduction you're allowed to claim. And the reason is, in my opinion, that there's been no adjustment for inflation over time. And originally, those limits were set in place to prevent businesses from claiming big deductions on luxury automobiles. Well, A luxury automobile, maybe in 1980, you could say a luxury automobile would have cost you $15,000, $20,000, and that was really a luxury. Well, today, $15,000, $20,000 is your basic average price of a pretty much normal average car. And if you get into the bare bones cars, the tiny little four-cylinder cars with the tiny little engines, maybe you're talking $9,000 or $10,000 for the very most inexpensive of cars, like a Yaris or a Geo Metro type car. And those would hardly be called luxury, but even if you spent that much, odds are you're probably going to get affected by a limit in your first year. So the depreciation limits on automobiles that were originally intended to prevent big deductions on luxury vehicles essentially prevent anyone from claiming a full deduction on a new passenger car for most of the years it's in service. So here is an example of what I mean. How do you go about calculating depreciation for an automobile placed in service during 2010? Well, on April 1, 2010, you purchased and placed in service a 2010 Dodge Caravan that cost $35,000. Since the car weighs less than 6,000 pounds, it is considered listed property and is subject to the limits on automobiles. According to your records, you use the 2010 Caravan 30% for personal use and 70% for business use. And you elect not to take the 50% special depreciation allowance. You calculate your depreciation as follows. So for year one, if you take that purchase price of the car, which is $35,000, and multiply that by 20% under 200% declining balance makers tables, you get a deduction of $7,000. Well, you're going to have to multiply that $7,000 by 70% business use, and that gives you $4,900. But wait, you're not allowed a $4,900 deduction because of the limits on automobiles. And for 2010, that first year limit is $3,060. But wait, you must apply the limit or multiply the limit by the 70% business use. So that limit comes down to $2,142. So is the depreciation limited? You bet it is, really limited. You are allowed to claim only $2,142 in the first year. Let's go over to year two. And in year two, under the maker's depreciation tables, you are allowed 32% of the original cost of that vehicle, or 40% of the declined balance of that vehicle. Well, we're going to go with 32% from the tables, and if we went on 32% from the tables in the second year, we would be allowed an $11,200 deduction. We multiply that by 70% business use to get $7,840, but wait, we have to apply the limits on automobiles. That's not going to give us $11,200. It's not going to give us $7,840 either, and we're not even going to get the $4,900 because we're going to have to multiply $4,900 by 70% business use, and when we do that, we get $3,430. So is our deduction limited in the second year? Absolutely. Yes, it is. On to year three. In year three, the maker's depreciation tables would give us $6,720 of depreciation. We multiply that by 70% business use. That takes it down to $4,704. But wait, under passenger automobile limits, the third year of use on a car is limited to a maximum deduction of $2,950. And we further reduce that by multiplying it by the business percentage use. And that means that in the third year, our depreciation deduction on that car is only $2,065. In year four, the maker's tables gives us a deduction of $4,032. We multiply that by 70% business use. It gets us to $2,822, but we're not allowed that deduction. We're going to have to go for the limit on automobiles of $1,775 for the fourth and later years. We multiply that by 70% business use. And that means that in the fourth and all later years, as long as that vehicle is 70% business use, the maximum depreciation deduction allowed is $1,242. Here is another example. How to calculate the special 50% depreciation allowance. The information for this illustration is the same as the illustration I just showed you, except that you do elect to claim that special 50% depreciation deduction, and you calculate your depreciation for 2010 as follows. The purchase price of the vehicle is $35,000, and the special 50% depreciation allowance is $17,500. So that would leave you with a basis for depreciation of $17,500. Except wait, we have to deal with this limit on automobiles, and under the limits for automobiles, the maximum total deduction we are allowed is $11,060. We multiply that by 70% business use, and that gives us a first-year depreciation deduction of $7,742. Then what do we do with the remaining depreciation after claiming that 50% allowance? Well, in year one, we are going to take the remaining $17,500 cost basis, multiply that by 20%, and that gives us $3,500. We then multiply that by 70% business use. We get $2,450. But wait, we have that limit on automobiles, and well, we already hit that limit up here, didn't we? And then we already applied that limit by 70%. So essentially, under normal circumstances, if the limit were not to apply, we would get 70% of $17,500 plus we would get 70% of $3,500. But instead of that, we're going to be limited to a total deduction for both bonus and regular depreciation in the first year on this vehicle of $7,742. Then we move on to year two, and what happens? Well, in year two, we would be allowed, according to the maker's table, 32% of the remaining amount of basis eligible for depreciation, and that would be a $5,600 deduction. But wait, we have to multiply that number by 70%, and if we did that, we would get $3,920. We then need to apply the limits on automobiles, and for the first time, the limit is higher than our multiplied depreciation, except wait, we have to multiply that limit by 70%, and when we do that, $4,900 drops down to $3,360, and again, the limit is affecting us in the second year. And that same rationale goes all the way through, so whether we claim bonus depreciation or no bonus depreciation on this vehicle, we are hit with those limits. Please note that Publication 946 specifically states that vehicles weighing more than 6,000 pounds or used to transport persons or property for hire are not passenger automobiles. However, they are still other property used for transportation and are subject to the special rules for listed property. Other property used for transportation includes trucks, buses, boats, airplanes, motorcycles, and any other vehicles used to transport persons or goods. Deductions after the recovery period. If the depreciation deductions for your automobile are reduced under the passenger automobile limits, you will have unrecovered basis in your automobile at the end of the recovery period. If you continue to use the automobile for business, you can deduct that unrecovered basis after the recovery period ends. Note that you cannot claim a depreciation deduction for listed property other than passenger automobiles after the recovery period ends. Depreciation limits for trucks and vans. The maximum depreciation deductions for trucks and vans placed in service after 2002 are higher than those for other passenger automobiles. Vehicles such as minivans and sport utility vehicles that are built on a truck chassis are eligible for the higher limits. The following table shows the limits affecting trucks and vans after 2002. So essentially, we have a passenger automobile limit that affects automobiles weighing less than 6,000 pounds. And if it happens to be the case that you have a pickup truck, for example, that weighs less than 6,000 pounds, then it's still going to be affected by these limits. However, because the pickup truck is built on a truck chassis, it gets a slightly higher limit. Remember that in 2010, the first year depreciation limit on a vehicle that weighs less than 6,000 pounds is $11,060. Well, if your vehicle happens to be built on a truck chassis, you can bump that limit up by a whole $100. So for 2010, if you happen to place a small pickup truck in service in your business, the first year limit that will apply, assuming you claim bonus depreciation, is $11,160. In the subsequent year, that is the second year, rather than being subjected to a $4,900 limit, the limit is actually $200 higher at $5,100. Third year limit is $3,050, and fourth or later years is $1,875. And you can see that for several years going back in time, the depreciation limits on vehicles weighing less than 6,000 pounds that are built on a truck chassis get a slightly higher limit on deductions than cars that are not built on a truck chassis. Now we're going to talk about the depreciation rules that affect SUVs. The following information applies to SUVs. The depreciation limits for automobiles apply only to passenger cars, that is, vehicles weighing less than 6,000 pounds. SUVs and vans with gross vehicle weight ratings of more than 6,000 pounds are not considered to be passenger cars. Therefore, the depreciation limits affecting passenger cars do not apply. SUVs and vans weighing more than 6,000 pounds are still considered to be listed property. So do not confuse listed property with the limits on passenger automobiles. They're completely different concepts. It happens to be the case that passenger cars are a form of listed property, but the special rules affecting passenger cars that limit the amount of depreciation you are allowed to claim have to do with the weight of the vehicle. So SUVs and vans that weigh more than 6,000 pounds are listed property, and you can still only claim a Section 179 deduction on a vehicle that is listed property when it is used more than 50% for business use. Limits on claiming a Section 179 deduction for purchase of an SUV. Well, for many, many years it was the case that if your car weighed more than 6,000 pounds, you weren't affected by the limits on passenger automobiles. And of course, as you might imagine, that gave people a business incentive to purchase vehicles that were big and heavy. So SUVs became a very popular item. They went from almost never being seen on the road to being everywhere on the road and being one of the dominant vehicles on the road, especially the ones that weigh more than 6,000 pounds. And that's because if they were purchased for business use, there was no limit on the amount of depreciation you could claim. If you could show that you purchased a big fancy Cadillac Escalade weighing, I don't know what they weigh, but let's just say they weigh 7,500 pounds. They're big, heavy vehicles. And you purchased that vehicle and it costs you $60,000 loaded to the hilt, you could claim the entire purchase price as a deduction in the year of purchase if you could show it was 100% business use. So there was this movement over time to purchase these big, heavy vehicles, and the movement was away from the more fuel-efficient, smaller vehicles. Well, finally, the government took a look at this and decided to put a limit on the amount of deduction you could claim on an SUV. Well, if you ask me, it still doesn't give you much of an incentive to purchase a small car over an SUV, other than the economic aspect of the fuel economy of an SUV is, of course, not very efficient. And over time, people are moving back to the small cars for fuel efficiency reasons, but in terms of depreciation reasons, you're still better off buying a big, heavy gas guzzler. So the maximum Section 179 expense deduction for certain sport utility vehicles and other vehicles placed in service after October 22, 2004 is $25,000. So remember I told you there was a date where they decided to change things? Well, that date was October 22, 2004, and how they changed things is they were saying, okay, well, if you spent $60,000 on that fancy Cadillac Escalade, we're not going to let you claim all $60,000 as a deduction under Section 179 in that first year. We're going to limit your maximum deduction on that vehicle to $25,000 under Section 179, and then you're still allowed to claim regular depreciation on the remaining balance. So it's not like a total punishment, but it was taking away or putting somewhat of a limit on the amount of deduction that can be claimed on these big luxury vehicles in the year they're placed in service. Now, the portion of the vehicle's cost taken into account for figuring your Section 179 deduction for property used less than 100% for business is still limited to $25,000. So if you purchased a $60,000 Escalade and you only used it 60% for business, you would still be allowed that $25,000 deduction. So which SUVs are affected by this $25,000 limit? This $25,000 limit on the Section 179 deduction rule applies to any four-wheeled vehicle primarily designed or used to carry passengers over public streets, roads, or highways that is not subject to any of the passenger automobile limits and is rated at no more than 14,000 pounds gross vehicle weight. So essentially, the IRS has not created a situation where an SUV that weighs more than 6,000 pounds is considered to be a passenger automobile weighing less than 6,000 pounds. That's not what's happening. The vehicle limits that apply to passenger cars weighing under 6,000 pounds are a completely separate issue, and they affect the total amount of depreciation allowed on a vehicle weighing less than 6,000 pounds to the limit shown for the year. And that limit, it doesn't matter how you calculate your depreciation, whether you calculate it under bonus, whether you calculate it under regular depreciation, or whether you calculate it under the Section 179 deduction. No matter what you do, when you take those amounts and you add them up together, they can't be more than the limit. But when you go over to the SUV limit, we're on to a completely different thing, and the SUV limit applies only for purposes of calculating the Section 179 deduction. Your depreciation deduction using maker's depreciation tables or calculating depreciation using bonus depreciation methods is not affected. It's only the amount of Section 179 deduction that is affected, and that limit on the Section 179 deduction only impacts SUVs weighing more than 6,000 pounds that are not accepted types of vehicles. And I have in front of you right here a picture of what I believe is a Lincoln Navigator, and the Lincoln Navigator is specifically the kind of vehicle that is targeted under these limits. But all in all, you could still spend $60,000 on your Lincoln Navigator. You could claim a $25,000 Section 179 deduction on it, and then you could still claim bonus depreciation and maker's depreciation under double declining balance on the remaining portion of the cost of that vehicle. So although there is a limit in place on these SUVs, it is really infinitesimal in comparison to the limit that is imposed on regular passenger cars. Now, having said that there is a $25,000 limit on SUVs, I did want to show you the kinds of SUVs that are not affected by this limit. Because, for example, you could have a construction company that goes out and purchases a vehicle that you consider to be an SUV, such as a heavy-duty pickup truck. Or you could have a delivery service or a manufacturing company that purchases a delivery van. And is that delivery van considered to be an SUV? Because if you look at this description here, it has 4 wheels, it is designed to carry passengers over public streets or roads or highways, is not subject to passenger automobile limits, and does not weigh more than 14,000 pounds. So can we think of any vehicles that are described by that description? Well, sure we can. We can think of these larger passenger vans, we can think of larger pickup trucks, and we can think of delivery vehicles like this Sprint vehicle that is used for delivery. It's manufactured by Freightliner Mercedes. So the $25,000 limit, though, does not apply to any vehicle that is designed to have a seating capacity of 9 or more persons behind the driver's seat, such as this van. As you can see, it has 3 rows that seat 3 passengers behind the driver, so it has seating capacity of 9 or more behind the driver and therefore would not be affected by the limits. Also, vehicles that are equipped with a cargo area of at least 6 feet in interior length that is an open area or is designed for use as an open area but is enclosed by a cap and not readily accessible directly from the passenger compartment. Well, what they're referring to is we have the driver compartment and we have an area behind the compartment that is not readily accessible from the compartment, and that area can store cargo or carry cargo, and it is at least 6 feet in interior length. And of course, you're describing a big pickup truck like a Ford F-150 or a Ford F-350, for example. Those are large pickup trucks. They weigh more than 6,000 pounds, and they're also accepted from the SUV limits. Also, any vehicle that has an integral enclosure fully enclosing the driver compartment and load-carrying device, does not have seating rearward of the driver's seat, and has no body section protruding more than 30 inches ahead of the leading edge of the windshield. Well, I think we've got less than 30 inches poking out here on the front of this vehicle. There's no seating capacity behind the driver's seat because this is all for cargo. Sounds to me like this would be a vehicle that is also accepted from the limit. So how do you go about claiming depreciation on a passenger automobile? Well, to claim depreciation on a passenger automobile used for business, you must complete Part 5, including Sections A and B of Form 4562 on page 2. So you complete Section A, and you either identify that vehicle as being property used 50%, more than 50% in a qualified business, or as a vehicle used 50% or less in a qualifying business. If it's used 50% or less, you enter it on line 27. If it's more than 50%, you enter it on line 26. So that's Section A and what has to be entered in Section A. Then you must also complete information in Section B, and you must enter all of this information that covers how the vehicle was used. On line 30, you enter the total business investment miles driven during the year, not including commute. Then on line 31, you enter commute miles that were driven, and on line 32, you enter the total of all other personal non-commuting miles driven. I believe that IRS goes out of its way specifically to give a line to commute miles because the IRS says that commute miles are not business miles, and they want to make sure that people do not include commute as a part of business, so they give it its own line. Then on line 33, you enter the total of all miles driven for the year, which is 30 plus 31 plus 32. On line 34, was the vehicle available for personal use during off-duty hours? Well, that's a question you ask your client. Hey, was your vehicle available for use during off-business hours? Yes or no? And you wait for your client to answer that question. Well, it's probably going to be a yes. Most of the time that's the case anyway. On line 35, was the vehicle used primarily by a more than 5% owner or related person? So if you're the owner of your business and you were using a vehicle in your business, then you're going to need to say yes to that question. Number 36, is another vehicle available for personal use? Yes or no? Leasing a vehicle. If you lease a car, truck, or van that you use in your business, you can take the standard mileage rate or actual expenses to figure your deductible expense. You can also deduct lease payments. Now, because the limits on passenger automobiles are so restrictive, it is not at all common for people who use their vehicles for business to make a decision to lease rather than buy. If you lease a vehicle, you're going to be able to claim a deduction for the lease payment, and you would then, of course, multiply that lease payment by the business use percentage. And that lease payment, obviously, in terms of the cost of the vehicle, factors into itself the amount that vehicle is depreciating over time. And so when you're using a car, obviously that car is dropping in value, therefore it is depreciating in value. And that depreciation or loss in value that is occurring while you're driving that vehicle is factored into your lease payment. So clearly, if you're allowed to deduct the lease payment in full, then the passenger automobile limit is not really affecting you. So it's kind of a way around that limit on passenger automobiles that people do take advantage of. Deducting lease payments. If you choose to claim actual expenses for your leased car, you can deduct the portion of your lease payment that corresponds to the percentage business use. You cannot deduct any part of a lease payment, though, that is for personal use of the car, such as commuting. You must spread any advance payments over the entire lease period, and you cannot deduct any payments you make to buy a car, even if the payments are called lease payments. So how do you know if you're buying a car with a lease or whether you're just leasing a car? Well, the facts and the circumstances would dictate that. If you purchase a car under a lease, typically there's a buyout clause at the end. And if it is your intention at the end of the lease period to buy that car out, then in effect the lease is just a method of financing the vehicle, and it's not really a lease as far as your intentions go. It may be a lease on paper, but not according to your intentions. On the other hand, if you do lease a car for 2 or 3 years, say, and you fully intend at the end of that lease period to turn the vehicle back in and acquire a new one, then it is a lease. So IRS says if you lease with the intention of buying, then the passenger automobile limits apply. But if you lease a vehicle with the intention of turning it back in, then the limits don't apply, at least in terms of whether or not you are allowed to deduct the lease payment. But there is an important thing you should be aware of, and that is something called an inclusion amount. To read more about inclusion amounts, which are important, you should see publication 463. So if you happen to get a client who has purchased a car under a lease and they want to claim their lease payments as a deduction, you need to refer to publication 463. Because if you lease a car that you use in your business for a term of 30 days or more, you may have to reduce your deduction for your lease payment by an inclusion amount. The purpose of the inclusion amount is to create an effect similar to the limit on the depreciation deduction that you would have on a car if you owned it. The inclusion amount is a percentage of the part of the fair market value of the leased car multiplied by the percentage of business and investment use of the car for the year. It is prorated for the number of days of the lease term in the tax year. Well, the inclusion amount sounds like it would be a pretty serious limit that you have to figure, and it is a real limit that you do need to figure, but when you're all done with it, you'll see that the inclusion amount is a tiny fraction or has a tiny fraction of the effect that the limit on automobiles does. So although it's intended to do the same thing that the limits on automobiles does, it really doesn't do much of a job of it. Standard mileage allowance. You can claim the actual expense of operating your vehicle, or you can claim a standard mileage allowance. For 2010, the standard mileage allowance is 50 cents per mile. This rate is meant to cover all of the costs of operating your car, including gas oil repairs and depreciation. If you claimed the standard mileage allowance during 2010, 23 cents of each mile you claim is for depreciation, and the remaining 27 cents per mile is allocated to the operational costs of the vehicle. Well, Makers limits your depreciation when claiming the actual cost of operating your car. If you claim the standard mileage allowance deduction, then the limit does not apply. So the reality of the situation is that the limits on automobiles is so restrictive that unless you purchased an SUV, you're almost always going to be better off claiming the standard mileage rate instead of actual expenses, because your actual expenses for depreciation are really, really limited. But if you drove your car 15,000 business miles during the year, well, how would you figure your deduction? You would go 15,000 business miles times 50 cents a mile, and that would give you a $7,500 deduction. And of that $7,500 deduction, 23 cents per mile is for depreciation. So 15,000 times 23 cents gives you $3,450 of allowed depreciation on that car in the first year. Well, you could claim bonus depreciation in the first year on that car, but if you did so, you wouldn't be allowed to claim the standard mileage rate in later years. And in later years, you're going to be better off not being limited by that depreciation limit. So if you claim depreciation in 2010, 23 cents of each mile you claim is for depreciation. 27 cents is allowed for all of the other operational costs of the vehicle. That only matters really when you go around to sell the vehicle or figure your adjusted basis in the vehicle. In terms of calculating the actual deduction you enter on your tax return, you simply claim 50 cents for each business mile driven. So while Makers limits your deduction, when claiming actual cost of operating your car, you can basically avoid having to deal with that limit if you claim the standard mileage allowance instead. Now, there is one more important thing to know about depreciation on vehicles. The IRS has ruled that the value of original tires purchased with a vehicle shall be capitalized and depreciated at the same rate as the vehicle, but that the cost of replacement tires purchased during the year shall be deducted as an operating expense of the vehicle. And what this means is that if you purchased a new car and your car came with tires, those tires are a part of the original acquisition price of the car, and they get depreciated with the car. But if after driving the car for 3 years you decide it needs new tires and you pay for new tires, if you've been claiming the standard mileage allowance, the cost of those replacement tires is a part of that standard mileage allowance. You're not going to be able to claim a cost for replacing the tires. But if you're claiming actual expenses on the vehicle, and in a year you replace the tires on that vehicle, and tires can be pretty expensive, easily $1,000 to replace all 4 tires on a vehicle sometimes, well, that's a big repair expense, and you would claim it as a repair expense. So if you're claiming standard mileage, you would ignore the costs that you allocated to tires because they are a part of the standard mileage. But if you're claiming actual expenses, then the replacement tires would be a part of your actual cost of operating the vehicle. So here is a passenger automobile depreciation rules summary. The amount of depreciation and Section 179 deduction you can claim on passenger automobiles is limited. A passenger automobile is any 4-wheeled vehicle primarily for use on public streets, roads, and highways, and rated at 6,000 pounds or less. Passenger car limits and listed property. Depreciation limits apply to passenger cars weighing 6,000 pounds or less. SUVs and vans with gross vehicle weight ratings of more than 6,000 pounds are not considered to be passenger cars. Therefore, the depreciation limits affecting passenger cars do not apply to them. SUVs and vans weighing more than 6,000 pounds are still considered to be listed property. You can only claim a Section 179 deduction on a vehicle that is more than 50% business use. Deduction limits for passenger cars. For taxpayers who purchase a new business use car in 2010, a special allowance allows a deduction equal to 50% of the depreciable basis up to $11,060. For taxpayers who purchased a new business use car between September 11, 2001 and December 31, 2004, a special allowance allows a deduction equal to 30% of the depreciable basis up to $7,660. And for new business used cars purchased between May 6, 2003 and December 31, 2004, a special allowance allows a deduction equal to 50% of the depreciable basis up to $10,710 in 2003 and $10,610 in 2004. For new vehicles purchased in 2008 or 9, higher limits also apply if the 50% bonus depreciation is used. And again, here is the chart showing those limits. And as a reminder, to qualify for the $11,060 limit in 2010, a taxpayer must claim the special 50% allowance deduction. And in earlier years, where bonus depreciation was allowed, you had to claim that bonus depreciation to be allowed the higher limit on a vehicle in those earlier years. Here we are in 2010, and as a student just getting into taxes, you might be saying, well, why do I have to care about what happened in earlier years? Well, it's quite conceivably possible you could have a client who purchased a car and placed it in service in one of those earlier years where bonus depreciation was in play. And so you should be tracking or understanding that you need to track depreciation over time. And if you have to go back and recreate depreciation calculations based on earlier years for any asset that your client has that they're using in their business, you need to factor in depreciation rules that were in place in those earlier years when an asset might have been placed in service. Now we're going to move on to a discussion of amortization. In general, you cannot depreciate intangible property placed in service after October 10, 1993. The following property cannot be depreciated and must be amortized. Certain Section 197 intangibles: a patent, copyright, formula, process, design, pattern, know-how, format, or similar item. A computer-based intangible, for example, a composition of market or market share. A covenant not to compete entered into in connection with the acquisition of a business, and a franchise, trademark, or trade name, including renewals. Startup and organizational costs. When you start a business, treat all eligible costs you incur before you begin operating the business as capital expenditures which are a part of your basis in the business. Generally, you recover costs for particular assets through depreciation deductions. However, you generally cannot recover other costs until you sell the business or otherwise go out of business. You can elect to amortize or, with certain limits, deduct the following costs for setting up your business. Business startup costs are amortized under Section 195. Organizational costs for a corporation are amortized under Section 248, and organizational costs for a partnership are amortized under Section 709. Business startup costs. Startup costs are amounts paid or incurred for creating an active trade or business or investigating the creation or acquisition of an active trade or business. Business startup and organizational costs can be capitalized, amortized, or with certain limits deducted. If you choose to amortize your business startup costs, you must amortize them over 180 months. Organizational costs. Organizational costs include the cost of creating a corporation or partnership. Qualifying costs. A startup cost is amortizable if it meets both of the following tests. It is a cost you could deduct if you paid or incurred it to operate an existing active trade or business in the same field as the one you entered into. And it is a cost you pay or incur before the day your active trade or business begins. Startup costs include amounts paid for the following: an analysis or survey of potential markets, products, labor supply, transportation facilities, etc. Advertisements for the opening of the business. Salaries and wages for employees who are being trained and their instructors. Travel and other necessary costs for securing prospective distributors, suppliers, or customers, and salaries and fees for executives and consultants or for similar professional services. So what this is saying is that if you're getting ready to open your doors for business, you've decided to open a business, or maybe you already have a business but you're deciding to open another location, the IRS says that these costs associated with getting ready to open your doors for business are startup costs. And startup costs don't just get deducted as if you were already in business because, well, you're not in business at the time you incur them. You're getting ready to open for business. And so all of the costs that you normally deduct as business costs, you don't deduct until you open for business. When you open for business, you take the total lump sum amount spent getting ready to open for business and you do something with it. And you can either deduct it as a startup cost under the rules allowed for startup costs, or if you don't qualify, then you have to amortize those startup costs over 15 years. Non-qualifying costs. Startup costs do not include deductible interest, taxes, or research and experimental costs. Purchasing an active trade or business. Amortizable startup costs for purchasing an active trade or business include only investigative costs incurred in the course of a general search for or preliminary investigation of the business. These are costs that help you decide whether to purchase a business. Costs you incur in an attempt to purchase a specific business are capital expenses that you cannot amortize. Costs paid before October 23, 2004. For costs paid or incurred before October 23, 2004, you can elect an amortization period of 60 months or more. So for startup costs incurred after October 22, 2004, the amortization life is 15 years. But if you had startup costs before that date, then in those days, the startup costs could be amortized over just 5 years. Costs paid after October 22, 2004. For costs paid or incurred after October 22, 2004, you can elect to deduct up to $5,000 of business startup and $5,000 of organizational costs. The maximum deduction is reduced by the amount your startup or organizational costs exceed $50,000. You are not required to attach a statement to make this election. Once made, the election is irrevocable. Any cost not deducted currently must be amortized ratably over a 180-month period. The amortization period starts with the month you begin business operations. When startup or organizational costs exceed $50,000, the $5,000 figure must be phased out. Any remaining balance not currently deductible is amortizable over a 15-year or 180-month period. The amortization period starts with the month you begin business operations. Special rules for 2010 startup costs. For tax years beginning in 2010, you can elect to deduct up to $10,000 of business startup costs paid or incurred after 2009. The $10,000 deduction is reduced, but not below zero, by the amount such startup costs exceed $60,000. Any remaining costs must be amortized. Now we're going to take a look at completing Form 4562. Complete instructions for Form 4562 should be handy and next to you as you begin working on our assignments for today's class. But in the manual, I'm giving you just a brief summary of what those instructions tell you to do. Beginning with line number 1. You should use Worksheet 1 in the instructions for Form 4562 to figure the amount to enter on line 1 of Form 4562. The maximum amount that you can generally enter on line 1 is $500,000. Line 2, enter the total cost of all property, including the total cost of qualified real property that you elect to treat as Section 179 property, placed in service during the year for all business activities of the taxpayer that is eligible for the election under Section 179. If the taxpayer has more than one business, file a separate Form 4562 for each business activity. However, the amount shown on line 2 will be the total for all assets placed in service in the combined activities. Do not include the cost of any asset placed in service that is not eligible for the election, such as real estate. Line 3. Use Worksheet 1 to figure the amount to enter on line 3. The maximum amount is generally $2 million. Line 4. If the combined total of all assets shown on line 2 is more than the total of line 3, subtract line 3 from line 2 and enter the result here. And here's an example. XYZ Inc. placed $2,010,000 of Section 179 property in service during the year. We need to take $2,010,000 and subtract out $2 million. The difference is $10,000, and $10,000 is the amount that we would enter on line 4. On line 5, subtract line 4 from line 1 and enter the result here. If the amount on line 4 is greater than the amount on line 1, your Section 179 deduction is 0. And here's an example. XYZ company must reduce its maximum allowed Section 179 deduction by $10,000 as follows. $500,000 minus $10,000 equals $490,000. This means that XYZ can claim a maximum Section 179 deduction of $490,000. Well, let's just stretch this out a little and suppose that the amount placed in service during the year was $2,500,000. Then $2,500,000 minus $2 million would be $500,000. And $500,000 minus $500,000 would be zero. And in that situation, the deduction for under Section 179 would be zero. So that's how that phase-out works. It starts at $2 million, and by the time you get $2,500,000, your Section 179 deduction has phased away. Line 6A, provide a description of each asset for which a Section 179 deduction is claimed, but do not list any asset which is listed property. Listed property is reported in Part 5 of Form 4562. Line 11, the total cost you can deduct is limited to your taxable income from the active conduct of a trade or business during the year. Part 2 of Form 4562, this is where we enter special depreciation allowance and other depreciation. Line 14, if qualified property was placed in service this year, enter the amount of 50% or 100% bonus depreciation, if it is allowed, that you are claiming. On line 15, if you are electing to depreciate property using a unit of production method or other depreciation method not based on a term of years, enter the depreciation deduction being claimed here. Also attach a separate sheet providing additional information about the items being depreciated under this system. On line 16, you enter depreciation being claimed for these property types, including acres property, property placed in service before 1981, certain property acquired from related persons, property acquired in certain non-recognition transactions, certain sound recordings, videotapes, and movies, and intangible property other than Section 197 intangibles, including computer software, which is depreciated straight line over 36 months, and any interest in a patent or copyright not acquired as a part of a business. Other intangible assets with a limited useful life that cannot be accurately estimated also go here. Part 3, Maker's Depreciation, Section A. Enter on line 17, depreciation for assets placed in service in years prior to 2010. Use a depreciation schedule to figure the amount of depreciation to enter. On Section B, on lines 19A through I, you should provide information as required for each asset class placed in service during the year using the general depreciation system. On lines 20 through A through C in Section C, you should provide information as required for each asset class placed in service during the year using the alternative depreciation system. The following types of assets must be depreciated under ADS. Tangible property used predominantly outside of the United States. Tax-exempt use property. Imported property covered by an executive order of the President of the United States, and property used predominantly in a farming business and placed in service during any year in which you make an election under IRC Section 236AD3 not to have the uniform capitalization rules of Section 263A apply. Part 4 of Form 4562 is a summary. On line 21, enter the total from listed property shown on line 28. On line 22, you add up the amounts on line 12 and lines 14 through 17, lines 19 and 20, and line 21, and enter the total here. Also for line 22, partnerships and S corporations do not make an entry on this line for any expense deduction claimed under Section 179. Instead, any Section 179 deduction is passed through separately to the partners and shareholders on the appropriate lines of their Schedules K1. Part 5, Listed Properties, Section A. On line 25, calculate the Section 179 expense deduction before calculating any special depreciation allowance. Line 26, provide required information for listed assets used more than 50% in a qualified business activity. Line 27, provide required information for assets used 50% or less in a qualified business activity. Section B, information on vehicles. For each vehicle identified in Section A, you must complete lines 30 through 36. There is an exception. Employers are not to provide this information for vehicles used by employees who are not more than 5% owners or related persons. And Section C, question for employers who provide vehicles for use by their employees. If you are an employer who provided your employees with a company vehicle, you must complete this section. See page 13 of the instructions for Form 4562. How to claim amortization. Claim amortization by completing Part 6 of Form 4562, Depreciation and Amortization. Assets placed in service at any time during the month are treated as placed in service on the first day of the month. Part 6, Amortization. On line 42, provide the required information for assets with amortization periods that begin in 2010. Refer to pages 14 through 15 of the instructions for Form 4562 for information on the section code to be shown in column D. And on line 43, report the amortization deduction for costs that began prior to 2010. So this concludes the lecture portion of Session 14 on depreciation, and it's time to really start trying to absorb some of the information that I've given you today. And I'd like you to begin with your classwork assignment. Your classwork assignment is a multi-part assignment, and the first part is to categorize the following assets as tangible personal, intangible personal, or real property. For question number 2, you need to prepare a depreciation schedule for each of the following assets. We do not want you to take 50 or 100% depreciation allowance for any of the assets, but we do want you to claim a Section 179 deduction where it is allowed. Assume that business income is $515,000 and assume the following information for the car. Business miles are 12,000, total miles are 23,500, and commute miles are 4,000 miles. Here are the assets, and you will see that we have assets used in 2 different businesses, and that means you will need to prepare 2 separate depreciation schedules. Do not mix assets from different businesses onto one depreciation schedule or one Form 4562. Ultimately, you need to prepare 2 depreciation schedules and 2 Forms 4562, dividing the assets appropriately. And then, of course, Part 3 of this assignment is to complete Form 4562. So at this point, please push pause on video playback, prepare a depreciation schedule and Form 4562 for the assets shown, and then resume video playback for a review of how to accurately complete a depreciation schedule and Forms 4562. Thank you, and I'll see you in a few minutes. Okay, welcome back, and let's go over the answer key, or at least the answers to classwork assignment number 1. The assignment asks you to categorize the following assets by giving their property type as either tangible, personal, intangible, personal, or real property, and then further to describe the property as either depreciable, amortizable, or not depreciable at all. Let's take a look at the office building. That one should be easy. It is real estate, so it is real property, and of course it can be depreciated if it is used in a business. Shares of stock are actually considered to be tangible personal property, and of course you cannot depreciate shares of stock. Series EE or HH bonds are also considered to be tangible personal property, and they are non-depreciable. A truck, assuming it's used in a business, of course, is personal property. It is tangible, and it is depreciable. A rental house is tangible, real property, and it is depreciable. A vacant lot is tangible, real property, but it is not depreciable. A cow, assuming it is, say, a breeding cow or a milk cow used in a farming business, is personal property. It is tangible, and it is depreciable. A single-use agricultural or horticultural structure is tangible, personal property that is depreciable. Goodwill is intangible, personal property, and it is amortizable. Franchise fees are also considered to be intangible. They are personal property, amortizable. Store counter, tangible, personal property that is depreciable, and startup costs are intangible, personal property that are amortizable. Moving on now to question number 2. Prepare a depreciation schedule for each of the following assets. Don't take bonus depreciation, but do take Section 179 allowance where it is allowed. Assume business income of $515,000. Business miles on the car were 12,000. Total miles 23,500, and commute miles 4,000. We then look at the assets being depreciated. We have a Schedule C activity and we have a Schedule E activity. We have to divide the assets being depreciated between the two activities. That means 2 depreciation schedules and 2 Forms 4562. The Schedule C will include the car, the office building, the cell phone, the laptop computer, the desktop computer, and the desk. We have to observe the cost, the date placed in service, and the percentage business use. Land value has to be subtracted from the depreciable basis of the property, and the portion of the cost that is for land cannot be depreciated. All of the assets were placed in service in the current year with the exception of the office building, so that means all of these assets will have to be listed on Form 4562 because it is the first year they are placed in service. But the commercial building, because it is not the first year it's in service, actually it's the second year in service, will actually be entered on line 17 of Form 4562, whereas all of these other assets are listed either on line 19 under regular depreciation, or they're entered up in Part 1 for Section 179 deduction, or they are listed in Part 5 if they, of course, are listed property. So let's take a look at this. We actually have to begin Form 4562 by completing page 2. And this is something that I often get questions from my students is, how do I know whether I start with page 2 of a form or page 1 with a form? And you make that decision by looking at the form itself. And if on page 1 of the form it says to pull a number that you computed on page 2, then it stands to reason that page 2 is ultimately the place you're going to need to start. And Form 4562 is a form where you are asked on at least 3 different lines on page 1 of the form to pull numbers that you calculated on page 2. So therefore we start on page 2, and we're going to begin with Part 5 in Section A, where we're going to enter information regarding the car and the laptop computer because both of those are listed property. We list those assets in there, and then we compute the depreciation on them. The car is subject to the limits on passenger cars, and the maximum allowed depreciation for the car in the first year is $3,060. We're going to have to multiply that $3,060 number by the car's business use, which is 51%. And so we get 3,060 times 51% equals $1,561 as a maximum deduction. Now the instructions do tell you to claim a Section 179 deduction where it is allowed. So ultimately the entire depreciation deduction for the car will be claimed under Section 179, and we will not claim any maker's depreciation this year. We calculate the cost in the car for purposes of depreciation by taking the $35,000 cost, multiplying that by 15%, and getting the business use cost of the car, which is $17,850. For the laptop computer, we take the $2,500 purchase price, multiply that by the 45% business use, and we get a depreciable basis of $1,125. However, with regards to that laptop, it is not more than 50% business use, and therefore it's going to fall under ADS rules that require straight line depreciation. And so we will find that the first year depreciation is going to be $1,125 divided by 5 years, multiplied by the half-year convention, or 50%. So first year depreciation on that laptop is ultimately going to be $113. So let's take a look at the depreciation schedule that we prepared for the Schedule C. We've listed the assets in service on that business: the car, the office building, the cell phone, the laptop computer, the desktop computer, and the desk. And my instructions were to claim Section 179 deduction where it is allowed. And on the car, we are allowed to claim a Section 179 deduction because it is more than 50% business use, but we are hit by that limit on automobiles. So we'll see that we have the cost of the property, the business use percentage is 51%, but the Section 179 deduction is going to be limited to 51% of $3,060, and that gives us $1,561. We then take $35,000, multiply that by 51%, and subtract out the amount of Section 179 deduction we are claiming for the year. That leaves us with a depreciable basis of $16,289. The life of the car is 5 years. The method is 200% declining balance under the half-year convention. The rate is 20%, but the current year depreciation deduction is the same as the Section 179 deduction of $1,561. Accumulated depreciation is the same as current year depreciation because this is the first year in service. We then go over to the office building. The cost of the building was $250,000. We subtract out the land value, and of course the business use percentage is 100. The depreciable basis is $179,000, 39-year life, straight line mid-month convention. If we take $175,000 and divide that by 39, we're going to get $44.87 as the current year deduction. And of course, last year's deduction, where we got that number, or where we get accumulated depreciation of $87.87 from, well, we look at what the depreciation deduction would have been in the first year. And in the first year, we would have applied the mid-month convention. And since this building was placed in service in January, we would essentially take $44.87, divide that by 12, and multiply that by 11.5 for 11.5 months, and we would get the difference between $44.87 and $87.87. And I'll show you more detail about that in just a second. The cell phone is $150 cost multiplied by 45% business use, gives us a depreciable basis of $68. We are going to depreciate that over 7 years, double declining balance, applying the half-year convention. That gives us a first-year rate of 14.29% and a current year deduction of $10. The laptop computer is listed property. Cost is $2,500. Business use percent 45. Depreciable basis $1,125. Straight line half-year convention, and that gives us a first-year deduction of $113. The desktop computer and the desk are both being deducted under Section 179, and so we end up with Section 179 deduction on each of those, $800 and $450 respectively. The current year depreciation is zero, or the rate of depreciation is zero because they're fully expensed, and we have a current year deduction of $800 and $450 respectively. So let's take a look at the 4562 for this depreciation schedule, and we start with page 2, as I said. So here on page 2, we've listed the car and the laptop computer. The car appears on line 26 because it is used more than 50% in a business. The laptop computer is listed on line 27 because it is used 50% or less in a business. The cost of the car is $35,000 multiplied by 51% business use and subtracting out the amount of Section 179 deduction of $1,561. That leaves us with a cost or depreciable basis in the vehicle of $16,289, but the current year depreciation is nothing because we're already maxed out with the Section 179 deduction. Laptop computer, the cost is $2,500 multiplied by 45% business use. That gives us a basis for depreciation of $1,125. It is 5-year property. We apply the half-year convention and get $113. So line 28 will carry to page 1 of Form 4562 and is entered on line 21. And line 29 will carry to page 1 and is entered on line 7. Of course, we have to complete Section B and answer the appropriate questions, recording to the number of business miles, the number of commute miles, the total number of personal miles, and the total number of miles put on the vehicle. Was the vehicle available for personal use during off-duty hours? Was it used by more than 5% owner? Those are questions that we did answer, and we didn't provide you with the information. We just sort of punched in some answers. But in the real world, of course, you would interview your client and get that information. So let's go back up to page 1 of Form 4562. And on page 1, we begin by entering the Section 179 deduction that we figured for the automobile on page 2, and we pull that over and plunk it down on line 7. We then move over to line 1, and the instructions for Form 4562 say that in most cases you will enter $500,000 on line 1, and that in most cases you will enter $2 million on line 3. Obviously, the value of property placed in service during the year is not more than $2 million, so we're not affected by a phase-out there. The profit of the business is more than the value of assets that we want to claim a Section 179 deduction on, so we're okay there. But exactly what do we enter as a number on line 2? It says enter the total cost of Section 179 property placed in service during the year. Well, let's just scroll up a couple of pages and I'll show you how we figured that entry. So for Form 4562, Part 1, Line 2, the amount to enter on Line 2 is figured by adding up the cost of all property belonging to a class that could be eligible for the Section 179 deduction. Since real estate is not eligible for expensing under Section 179, do not include the cost of the residential rental home in the amount that we enter on Line 2. But these are the cost of assets that we do enter. We have the car, the cell phone, the laptop computer, the desktop computer, the desk, and the refrigerator. Now, ultimately, the refrigerator cannot be Section 179 expensed because it was not used in a business. It was used in a rental. But still, it could possibly be eligible if it were used in the appropriate type of business, so it does get listed here. We then take the Section 179 cost and multiply that out by the business use percentage. And when we do that, the car, 35,000 times 51% gives us 17,850. The cell phone, 150 multiplied by 45% gives us $68. The laptop, 2,500 multiplied by 45% gives us $1,125. And of course, all of the other assets are 100% business use, and we list them as such. We get a round total of $20,793, and we carry that and enter that on line 2. Now, 4562 that you see on the answer key was actually created using tax software, and because of that, the software has actually rounded our entry down to $20,792. So if you came within $1, you're spot on. And then we go on and figure that we're not going to be limited on the amount of Section 179 deduction we're allowed to claim because the business profit is high enough and the cost of assets placed in service during the year is well under $2 million. We then move over to line 6 and enter a description for the assets that we're depreciating under Section 179, and they include the desktop computer and the desk. The total cost of all of these assets that is entered on line 8 is $2,811. Our deduction is not limited, and on line 12 we carry down and enter $2,811. Then on line 17 we enter the amount of depreciation being claimed on that commercial building of $4,487. On line 19, the only entry we're going to make is for the cell phone, and the depreciable basis for that cell phone is $68. It is 7-year property. We apply a half-year convention, and it is 200% declining balance, and that gives us a first-year deduction of $10. Now, you may be asking, how is it that we determine that the cell phone is 7-year property? If you go through the classification tables and look for where cell phones are listed, they're not listed anywhere. They are not a form of classified property. Any property that is not otherwise classified becomes 7-year property, and that's where we put cell phones. Then on Part 4, we enter on line 21 the listed property depreciation from page 2, and that was $113. And we then add up line 12, line 17, and we enter on line 22 $7,421. Moving over to the second depreciation schedule, we have the rental home and the refrigerator. And although the refrigerator is the type of property that normally would be classified as 7-year property, because it is placed in service inside a residential rental, it is actually classified as 5-year property. And of course, the residential rental house is 27.5-year property. We take the cost of the rental, subtract out the land value. That gives us a depreciable basis of $100. It is depreciated over 27.5 years under the mid-month convention straight line. So to calculate the first-year depreciation, you're going to go $100,000 and divide that by 27.5 years. You're further going to have to divide that by 12 months, and then, of course, multiply that out by 11.5 to apply the mid-month convention placed in service in January. That gives us a first-year depreciation and accumulated depreciation of $34.85. On the refrigerator, we have a 5-year asset. First-year depreciation on a 5-year asset is 20%, and that gives us $100. Here is the 4562 for the Schedule E, and we'll see we have 2 line entries, both in Part 3. On line 19B, we enter the refrigerator as $500 cost basis with a recovery period of 5 years, half-year convention, 200% declining balance, and a depreciation deduction of $100. We enter residential rental property placed in service in the first month of 2010, a depreciable basis of $100,000. The recovery period is 27.5 years, mid-month convention straight line, and our first-year deduction is $3,485. We add $3,485 to $100, and we enter on line 22, $3,585. The remainder of the answer key, the printed version, that is, of the answer key, provides further information on how we calculated depreciation for each of the assets. And, of course, you can feel free to read that in your own time. To access a printed copy of the answer key for the classwork assignment, the password is Morgan, M-O-R-G-A-N. So that concludes the lecture portion of Session 14 of the Basic Tax course. I leave you now to peruse the homework assignment and complete the reading and homework assignments for session 14. Homework assignment A is essentially true-false questions, fairly simple. Homework assignment B is similar to the classwork assignment we just completed. We ask you to prepare depreciation schedules and Form 4562 for the following assets. We provide you assets for two separate activities, but assume they belong to the same taxpayer, so they can interrelate on the Form 4562. That concludes session 14 of the basic tax course. Thanks for participating, and I will see you back again at session 15. Bye-bye.